So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Bloomberg Surveillance, good morning on a Monday. Yes, there's trading today. Pitched battle among the team at our 4 a.m. meeting, like when do the markets open, when do they close? I guess they open usual. That's all normal. But when do they close? I go to Catherine Greifeld for the close of the markets today. Bremo out, Farrow out, I'm in, Greifeld's in.
Mm-hmm.
We close at like 1 and 2. We don't close together.
No, of course not.
That would be too sensible.
We've got to complicate it. Equities close at 1 p.m. and then the bond market an hour later at 2 p.m. SIFMA.
So all the fat cats are out doing dressage in New Jersey, or they're out in the Hamptons pounding a beverage of their choice, and we're working and the staff's working at all the firms.
I begged to work today. You know, I'm thrilled to be here. So
really,
yeah.
Okay, it's an HR event in itself. Katie Greifeld with us. We're thrilled she's with us today because there's a lot going on. It's not a normal Monday. Cameron Dawson with us for the entire hour with perspective on the equity markets, fear of missing out, the regret forward. And with red and green on the screen, a little bit of a lift to the NASDAQ off Tesla news. When do we get to Tesla at some point with Mr. Webb?
I hope so.
Units
I'm looking
sold,
forward to that.
Gigundous Elon Musk moment. In the bond space, I got to go through this before we bring in his worship, and that is a 2-10 spread. This is a difference in yield between the 2-year yield and the 10-year yield. I call it the vanilla spread. It's not pistachio. And it's out to a number I think I've never seen, which is moments ago 110 basis points. The 2-year yield is 1.1% higher than the 10-year yield. And all you need to know, it's sort of like tulips and stocks a million years ago. Joining us now, the guy that wrote the book on this. We are thrilled that Tony Crescenzi could join us from PIMCO this morning. The Strategic Bond Investor is the grown-up book to read on it. It's in its 14th edition. You could buy half of Staten Island off for the royalties of it. From tulips to treasuries. How close are we to tulips, or are we buying treasuries?
I think we're closer to treasuries. The tulips view was a couple of years ago, but when treasury yields were quite low and yields globally were negative, about 18 trillion or so of negative yielding bonds. And that, in fact, that tulips idea, I think, will probably affect the bond market for a generation. What investor for the next 20 years will purchase a German Bund at minus 50 basis points again, given the carnage?
Are you looking at me in my Austrian 97 year? You're looking at me. Yeah.
And I say a generation because things change. Think about the housing market, of course. In 2008, 2009, we would have said the housing market will never rebound. And, of course, it certainly did, and vigorously. It takes time. But I think low and negative yielding bonds are probably out the door, out the window for quite a long time.
I'm looking at the splash this weekend from your shop in the Financial Times. They gave one Daniel Iveson, I think he's an intern with PIMCO, front and center headlines. Bond fund giant PIMCO prepares for, quote, harder landing for global economy. How does econobabble fit into total return in the fixed income market?
I think that view from Dan Iverson, Group CIO, is just a cautionary note. And it's all relative. When we say hard landing, we're saying relative to perhaps what others are expecting. At PIMCO, we're expecting a soft landing, but that may be harder than others are thinking. So in terms of a total return type portfolio, a Bloomberg aggregate style portfolio, which of course is a collection of bonds, treasuries, mortgages, corporates, mostly market cap weighted, you want to be up in quality, of course. So we think if there is a slowdown or a recession, the credit spreads could widen. The broader point is that one needn't take a lot of duration risk, credit risk, et cetera, to get good yields in the bond market. We're looking at 5%, 6%, 7% type returns in assets we think are so-called money good. So you needn't take a big leap. Consider, for example, Tom, where high yield bonds are. Even though they may be attractive to some, we'd say be cautious in the area at spreads of over about 400 basis points or so, 400 to 450 on average. It's kind of tight relative to what could happen in a recession with a spread of, call it, let's say, 800 basis points or more. And a widening of that magnitude can, in a total return style portfolio, be painful because there would be losses. And so we're saying prepare by keeping your powder dry and don't reach so much. You needn't these days with where yields are.
Well, to that point, I wanted to go to duration, so I'm glad that we're there. You think about where we were starting to get to on the 10-year Treasury yield, approaching 4%. We can put that back into the conversation. To your point that you don't have to reach that far, when you start to see the 10-year approach 4%, does that look like a good entry point?
Yeah, PIMCO believes, and I believe as well, because we kind of have different views within PIMCO. The range for the U.S. 10-year is probably now, we think, call it 3.3% or so to 4.25% or so. But when thinking about core fixed income and therefore duration relative to short-term products, which have very little duration, you should be thinking about the history. Since 1978, and forgive me with the earpiece falling out, since 1978, core fixed income, and the Bloomberg aggregate is a good representation of that, has outpaced Treasury bill returns on a 3-year rolling basis 90% of the time, and by a very substantial margin, 3 percentage points. And so these yields look attractive on that basis, and so one doesn't want to get into the game of market timing, because market timing for a diversifier is a very dangerous game. And I should add, Katie, that in core fixed income and this idea that they can outpace T-bills and have considerably since 1978, that the time for entering core fixed income is typically close to the peak for the Fed funds rate, which we think, and many think, the markets think, is upon us. And the typical timeline is called maybe up to 6 months prior, you're good. So you don't want to play the game of timing diversifier too much, is what we'd say. Final view is that if I add in 3 components really quickly, the inflation view, 2.5%, the market has a term premium, the extra yield you get from moving out the yield curve, and the real interest rate, where markets think the Fed funds rate should be relative to inflation. Those things together put a fair value in the current zone. So again, be cautious about the idea of market timing.
So don't try to time the market, but then you look at the $5.4 trillion in cash. Like you said, very little duration risk there. When does that start to move out, though?
It's a herd mentality in financial markets. Tom, you're quite familiar with this as well, and Katie, you too, in your time in the markets.
Tell
Cameron. But it's when others start to leap. But that's not optimal for an investor, and that's what active management is all about. That's why we would say now is the time, get ahead of the herd.
Yeah, but is Jerome Schneider, did he survive the first half of this year?
Yes, and quite well. In the short-term space, there's plenty to do as well. Consider, for example, you could purchase a T-bill and get in the low 5s, but there's asset-backed securities, assets that are backed by student loans, car loans, equipment.
Are you grossing 5% on Jerome Schneider short-term portfolios?
His short-term ETF we have, and not to tout it, but just as an illustration.
Please, it's Monday.
Mint, M-I-N-T, minting money. It's the yield is currently 5% or so.
It's unbelievable.
Just launched another one, too.
Back to my childhood.
The distribution yield.
Nobody at the table remembers this world, and it's like we're back to it.
But the asset-backed securities and a lot of short-term instruments have yields close to 6%.
Yeah. Tony, is it possible to see a benign re-steepening of the yield curve?
A benign re-steepening, meaning that I think what you're thinking, Cameron, is that in a steepening, some event has occurred to cause a flight into short-term instruments, the type of thing perhaps that Katie's thinking about that could cause movement. Not usually, of course. The history suggests perhaps not. But and many are thinking, can there be a soft landing? In the soft landing, that could occur. It may be occurring now. U.S. growth last year was about, economic growth was 1% or so. It's tracking a little higher today, but we think it'll be slower than that for this year. We're in a growth, the U.S. is in a growth recession today. Growth recession is something above zero, but below growth potential. The U.S. has a potential to grow each year about 1.8%. That's a combination of productivity, 1.5%, plus changes in labor force, about 0.3. The U.S. is growing below that, which enables supply to catch up with demand, the ability to produce goods and services to meet demand. It's catching up. And that can enable the steepening, because then the Fed can say, we needn't to raise interest rates anymore, and if supply catches up enough, if they're in a growth recession, it can happen. And then eventually there are interest rate cuts. But we'd caution that the view on interest rate cuts flies in the face of Paul Volcker, the legendary Fed chair. We've felt that for some time. I've certainly felt that personally very strongly for a long time now. This is the idea that the Chair Powell has today is to keep at it. And he's quoting directly from Paul Volcker in the book, Keeping at It. You have to persist with this view in the battle against inflation to defeat it. And that's what's happening. And this is why Chair Powell will go to heaven, so to speak, central bank heaven. And because, Tom, the view, and Cameron and Katie, the view is that only hawks go to central bank heaven.
Well, he also been saying that history warns against cutting rates too soon. So do you think that lower inflation is enough for the Fed to cut rates? Or do you think that we actually need to see higher unemployment, much weaker growth?
A lower inflation expectation would cut it. It is occurring, it is observable in the bond market through inflation-protected securities, which are priced for the inflation rate to be about 2.2% or so, but it's not observable in the general public. Think about various generations. I'm from the older generation. I'm a boomer, born between 46 and 64. Take your guess.
Really?
Which year that is, 64. But
slipped right into that.
But new generations of Americans have experienced inflation. So my generation did. We've always expected there could be inflation. Now the generations X, the millennials, and Z all believe that the prices can go higher, faster, and at any time.
Yeah.
So you've got to get it out of their heads. And so the public's view on inflation could be enough, and that's what's needed.
Let's I'm thinking of, I went back and forth this morning with Dr. Alarian. He's on a plane tomorrow. He'd be with us, on Wednesday. But let me ask you something Mohammed would ask, which is the unknown that's out there. And to me, if I look at the Bloomberg Total Return Index, Lehman Barclays Index, beautiful. There's a textbook, guys, Bulkowski. Everybody had to read Bulkowski with 457. It was almost as thick as Tony's Steigum's book. You had to read every chart pattern known to mankind. I'm sorry, bonds are in an absolute textbook pennant. No one's looking for price down, yield up. What if we get that unknown
Here's
out
the
there?
unknown that I think, and I wrote a book on this matter about the idea of a Keynesian endpoint, the idea of practical limits to the use of debt. There was evidence of that last fall when Prime Minister Truss wanted to increase the indebtedness. The markets reacted violently. The bond market collapsed. The pound got pounded, so to speak. And so what's out there, the unknown, is whether the bond markets would react violently again in other nations to increased indebtedness.
But Matthew, a guy out on Twitter this weekend, he brought up Sheldon Natenberg and all the Greek letters at Crescenzi, frankly, you're world class at. Do bonds display gamma? We all know equities display accelerated tendencies in a log normal space. Down they go when they go down. If we get price down, yields up, do you get bond gamma?
There was gamma in the UK last year. It was arrested, though.
I agree.
And luckily, the bond market is the cop on the beat in this sense that it disciplines the fiscal authorities, it disciplines the monetary authorities to say, no, you can't do that anymore. And so any yield rise from here, that gamma, the vol of vol, if you will, would be arrested by the bond market, disciplining politicians and the monetary authorities to avoid doing the things that could cause trouble
let's get out
for
on
the
a limb
bond
here.
market.
I mean,
So self-stabilizing.
Okay, but
Dan
Isaacson, Dan Isaacson of PIMCO, worldwide headlines this weekend. I don't think he's watching this morning. He's on some boat somewhere.
It's early in
Tahiti.
Newport Beach. It's 3:43.
That's okay. Maybe he's up. Who knows? Let me get you out on a limb here. Are we going to see the bond market discipline central banks in the next 18 months?
And if there were proposals to increase indebtedness and the monetary authority seemed to support it, I will make the bet yes. But it looks like, first of all, we've got an election ahead. There won't be such a plan on the fiscal side for some time. And one important point, Tom, is I think that this means that any yield rise would be self-stabilizing. So don't worry, and Katie, we were talking about duration, so don't worry so much. That'd be self-stabilizing. The bond market vigilantes are back.
Thank God Bramwell wasn't here. That was depressing. Tony Crescenzi, tanned and rested from PIMCO. Thank you very much.
So much.
James Athey, it's 7:30 this morning. Ellen Zentner in the 8 o'clock hour. Good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
That a lot of the good news is already priced into the stock. So when you think about the march to 3 trillion, it's mainly been on the back of the iPhone. The iPhone continues to perform very well. But when you think of the next trillion, and you think of Vision Pro and augmented reality and virtual reality, there are a lot of structural challenges even for Apple.
Bottle it. Tom Forte on Apple. He is neutral on the stock, hugely constructive long-term, but he's not a fanboy on Apple. That was a fascinating conversation. Look for that on all our digital products. It's out on YouTube somewhere. I'll get to that in the coming week, but that was a superb effort by Tom Forte of D.A. Davidson to inform on the product linkage to the financials and stock performance of AAPL. The same can be said about something that doesn't have the persistent cash flows of Apple, and that is TSLA. I believe that's a symbol, not that I've ever looked at it. We're going to dive into this right now. Joining us for the hour, Cameron Dawson with us here from New Edge Wealth. Thrilled that she could join us as well. And Catherine Greifeld in for Bramo and Farrell here today. We're having fun doing this. Katie, why don't you go to our guru? He's the only one I know that can fit in a Tesla.
Well, let's have that double-barreled conversation on both Apple and Tesla with Bloomberg Quick Takes Alex Webb. He joins us from London. And Alex, I want to start with Apple. Of course, the news out over the weekend from the FT reporting that Apple now preparing to make fewer than 400,000 units of its Vision Pro headset. And those, I believe, were downgraded expectations already. Looking forward, are we to expect further production goal cuts from here?
Well, look, Apple has never formally announced how many units it plans to sell. This has all come from reporting from, not least our colleague Mark Gurman, but over the weekend, the FT reporting that the numbers will be a bit lower. Even if they'd hit the higher end of what people have been reporting, it's still, from a revenue perspective, really going to be a rounding error when it comes to their overall revenue story. Perhaps, 1.5, 2 billion tops is what it might have been. They're projected to generate 400 billion in revenue this year. So let's put it in a bit of context. The only way this probably hurts them, if at all, is that this first generation is really about seeding the developer community, getting these devices out there so that they can build a whole gamut of apps and services that by the time they come out with a mass market product, it is way more appealing because there are loads of things that you can use it for. If this limits that slightly, it might hurt around the fringes, but this isn't significant.
Alex, it's a great point that really, if you look at Apple's holistic revenue picture, this is a drop in the bucket. But then you think about what we've seen in the stock market. Of course, Apple closing above that 3 trillion mark on Friday. How much optimism basically is built on the Vision Pro at this point?
It's partly about showing the defense they have, actually. So with the 3 trillion mark, it was trading at or around about its 12-month or average 12-month target price. We then saw a note come out from Citi on Thursday, which projects perhaps 30% above, 30% headroom above where the stock was trading, which perhaps helped get it over that sort of imaginary line. The real issue, though, was if Facebook was coming to market with, and it is coming to market with virtual reality, augmented reality headwear, and Apple's not in the space, and somehow that does become the really compelling product of the future, does that mean they have a huge issue? Well, now they have something out there that looks pretty compelling, looks as good, if not better, than anything that Facebook or Meta is coming out with. And so it means that if they are not going to be going into headwear, they still have the dominant iPhone, the dominant smartphone. They're pretty well positioned about any incursion in their kind of core computing interfaces.
What does the July 19th mystery look like, Alex? I mean, to get out front, I know it's, it's like, I know you look at the financials and all that, but when they put out their beautifully clear press release on the 19th, what will you look for?
I mean, any sort of comments about earnings projections into this quarter, because it will give a sense of perhaps exactly the launch date on the iPhone, how they see it doing. I think that, if the risk is in any upcoming product launch cycle is that people hold off, right? That they don't go for the latest iPhones because they're expecting a new one coming up. Now, if they're able to show strength in spite of that, it really shows just how strong the ecosystem has become, right? If they have got an ecosystem now that, you're going to be buying an iPhone just because you need a new phone rather than because the phone itself is that good, that itself, is demonstrative of the strength. But, I think it's really, this quarter is the least important.
Right.
It's really the Christmas quarter that people care about.
Cameron Dawson with us, and I'm honored to ask you this question. And Alex is one of our jewels. He's just really good on the product stuff. And of course, we have industry leader Mark Gurman as well on Apple. Do people like you care about all the product chit-chat of the financial media? Or do we overplay, Alex is going to get a new set of AirPods or whatever you call the things in the ears, and everybody goes hysterical. Do you care?
We do care, but it's about what moves the needle on the earnings basis. And what's interesting is that 2023 Apple earnings are expected to be down 2% and then just grow 10% next year in 2024. Is there upside to those numbers? Because all of the stock strength this year has been multiple expansion. And so that multiple seems worth it because of the high quality nature of the company. But to get to that next leg higher, that next trillion, you have to see it in the earnings.
Are you going to get the vision? Ask Alex about the goggles. I mean, I can see Cameron Dawson.
The ski goggles.
Going, fear of missing out. Oh, there it is. I can see the fear of missing out.
Well, it is a question to you, Alex, which is that, is this enough to really move the needle higher? Is this the next iPhone where we can have an entire ecosystem around it? Or do we need other product lines to get you to that next trillion?
I think it's the closer analogy that I think people compare it to is the watch, right? Which in its first year didn't do brilliantly. It's now meaningful, but it's not so meaningful that they break it out as a separate product category. I think that's also why people got quite excited about the car, because even if you don't sell big volume in the car in terms of units, it could still be quite a big revenue driver. You quite quickly get to, given the price point of those vehicles, you quickly get to a meaningful number. And so I think probably if you look towards the long term, that is actually, to my mind, more likely to be, if they do ultimately get their act together and bring something together, that's more likely to be something that gives a proper leg of growth.
And Alex, we promised a double-barreled conversation, so I do want to ask about Tesla. Of course, the news over the weekend there was those record sales numbers, those record deliveries. Is it safe to say at this point that those price cuts are working?
I think it does seem that they're working. I think you've got to think about what drove them, which is that actually Tesla had a massive expansion in capacity, and it was pretty poorly timed because all of a sudden demand started to falter. So yes, it's achieved that goal in boosting demand. It has come at the cost of margin. We've seen the net margin fall from something like 18% last year in some quarters to close to 11, 12% this year, but the market doesn't seem to care all that much. It is driving growth, and of course Tesla is still the sort of growth stock when so many others have been suffering.
Alex, how does Shanghai and China play into the Tesla future? Is it really a big deal? Is it tangential or germane to the debate and discussion?
It is fascinating because the nature of that factory they have there and the agreements they have, what they're allowed to do in terms of selling units elsewhere, how they direct the revenue, it's something that needs to be explored quite a bit. The thing that they have from a competition perspective is that they make very different cars from a lot of what the competition does. The Chinese car makers, particularly EV car makers, they are making cars with smaller batteries because they recognize it's more efficient. Most people don't need the 300-mile range on a daily basis. Tesla's building cars that are kind of for this European, US audience where range anxiety remains top of the list. And that's why we've seen a company like BYD, which sells far more units in its home market than Tesla does. You have to wonder whether that affects them in the medium to long term.
Alex Webb, thank you so much. Really appreciate it. Greatly, greatly appreciate it this morning. And Cameron, this goes to, I don't equate Tesla with Apple. Am I wrong on that?
No, they're two extraordinarily different kinds of companies. One is wildly capital intensive, and one is very capital light in Apple.
Yeah, but also the persistency of cash flow. I mean, what is Tesla going to have, 15 competitors?
Something like that,
by Christmas?
And growing.
I just don't get it. I just don't get the multiple equalization of all these 7 stocks.
I think it is a very big question, and people are still betting on this whole ecosystem with Tesla, which is that you just sell as many cars as you can, and then they're worth more with charging and AI-powered self-driving. But I think it still is a capital-intensive manufacturing business. So when you look at it trading at 64 times earnings, that should raise some eyebrows.
I love that word ecosystem because you think about the Apple ecosystem. It's in every single part of our lives. So
yeah, it is, but it's not in Graham, Dodd, and Cottle. And my radar's up when I hear Alex Webb. He says it so well. I mean, it's like he's like DiCaprio. but the answer is ecosystem. What is that?
Who knows? It's in the cloud.
It's in the cloud. Well, is she auditioning?
Yeah, she's good.
She's, maybe I mean, I get it. John and I can just go on permanent sabbatical. And
yeah, there you go.
It can be the Bramwell, Greifeld, Dawson Network. I think we're going to continue here. Cameron, thank you so much. Cameron Dawson with New Edge at Wealth as well. A lot going on a Monday. This is Bloomberg Surveillance.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
With sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that global central banks are going to keep policy restrictive well into the first half of next year.
The ECB is going to hike at least twice. Bank of England is going to hike at least twice. I really hope the Fed doesn't.
Our base case is still that the Fed probably only has one more interest rate hike in their pocket.
Even Powell has got to learn to stop tightening policy at some point.
The U.S. economy is really doing fine.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrell, Lisa Abramowitz, and Tom Keene on a Monday. A holiday-lengthened work week. We'll be off tomorrow, but we are here. Bremo on assignment. John Farrell on assignment. Kathy Greifeld, so strong Thursday and Friday. We brought her back. And the list of guests today, Katie, really say everything about the moment where we see twos, tens out to record inversion.
Oh, big time. To get the level of guests in on July 3rd on a holiday Monday almost really speaks to the uncertainty that's in the market, that's in the economy right now as we stare down the second half.
It's going to be interesting to see. We'll do a data check here in a moment to get you started. In the 8 o'clock hour, Jim Bianco scheduled to be with us, and Ellen Zentner will join us as well from Morgan Stanley. Let me go right into the data here and the news flow. I guess I got to flip it here, Katie, and go to oil. Thank you, Will Kennedy, for abruptly. Oil shifted. $69, American 71. Brent crude, a moonshot up to 76.03. Saudi Arabia and Russia act.
Yeah, there you go. So some news today on those supply cuts, but still not a huge reaction in the oil market. I mean, we were talking about what's priced in and the fact that the supply side is getting tighter, and yet you still have oil at these levels maybe speaks to maybe there's a recession.
Let me do a data check here right now, and then we're going to do the brief to get you started on a brief Monday as well. Stay with us, and you know, let's get, well, you're going to do it in the brief. I'll let you do the market close in the brief. I think the market's open normally on time. We'll have to see if that actually happens at 9:30. Red and green on the screen with the NASDAQ, a very small lift as well. The bond markets where all the action is. 2-year yield, I'm on the 5% watch. On the 2-year full faith and credit, 4.94%, 3.84 on the 10-year yield. 2s, 10s, as I mentioned. The 2-year yield, obscenely higher yield than the 10-year, out to 1.1 percentage points, move the decimal 2 places. 110 basis points of curve inversion for global Wall Street. That is sobering here on a 4th of July weekend. Oil, as I mentioned, with a lift as well. Dollar not giving me much love this morning, a little bit of strength. China with some challenges, 7.25 on yuan as well. Turkish lira not being idiosyncratic this morning. Please brief us on a Monday.
Well, before we get to those early closes, we do have some U.S. economic data coming out today. We have some PMIs, U.S. manufacturing PMI at 9:45 a.m. expected to hold steady below 50, solidly below 50. And then 15 minutes later, we get ISM manufacturing, a slight improvement expected there. And then equities close 1 p.m. The bond market follows an hour later at about 2 p.m. So that's pretty much all of today. You look ahead, what we're expecting for the rest of the week. Wednesday, we get those FOMC minutes from the June meeting. This is going to be interesting. Again, we got a lot of information at the June meeting, but we're going to get some more color on what was said behind the scenes. There were no formal dissents. I know there had been expectations that we were finally going to see some dissents. We didn't get them, so we'll get more color.
Did you read the minutes?
I didn't read the minutes yet because they're not out.
It's like Bramall reads them word for word, every single
Oh, you
word.
got to.
I don't. Every several, every some, every a few. Wednesday minutes, be there. What else do we have?
Okay, then Friday, it's Jobs Day. That's probably the biggest event of this week.
Yeah.
We'll see if anything else changes, but we're expecting to add about 225,000 jobs in June. The unemployment rate expected to defy Jerome Powell once again, tick down slightly to 3.6%. And wage growth, of course, there's been a lot of concerns about a wage price sort of spiral develop. It's expected to hold steady above 4% when you're looking at those year-over-year figures.
Katie Greifeld there with the brief of the day, and it's going to be interesting. And what's also interesting to me, diving into July, and let's remember there is a Fed meeting in July, and it's just fascinating to see off of the jobs report Friday, and then over to the inflation report that we will see. Someone focused on this right now. And it's real simple here with SPX up 2 points, is Sarah Hunt. She joins us this morning here on the equity markets and really that huge issue of who missed the market and who is in the market. Sarah, what's the agony here on mid-year correction? How many people actually missed the boat?
Well, I think the agony is for the people who are jumping in possibly now, hoping that it's just going to continue. And if we do get the pullback that people had been looking for originally, and or you start to see some real softness in earnings or inflation stays sticky, energy reinvigorates inflation, I think the problem is chasing it with that whole fear of missing out that you were talking about in your earlier hour, and then getting stuck in a position where finally earnings do start to come down, because it has been a multiple expansion, and the expectation that earnings are going to be higher next year, and even this year slightly higher over last year, seems to be it could be a little bit of a push given some of the margin problems that we're seeing.
Even if it's single-digit return, are you able to identify a second leg of a bull market before it occurs?
Well, since the bull market has mostly been in the technology stocks, the question is, do you see a pickup in other sectors that either catches up to technology, or do the technology stocks keep running and people keep chasing those? The rest of the market has only recently in June started to catch up at all. And even with that, there are sectors where we think that there is good value. I think the problem with technology is that once those headline names that are so big in the indices start running, it's very difficult for the rest of the stocks in the indices because they get bigger and bigger. So you have this math problem where the giant stocks get bigger and they push the indices higher and don't drag the rest of the market with it.
Well, to your point that we started to see a broadening out, it caught my eye. I mean, you look at the equal weight S&P 500, actually outperformed the S&P 500 in June slightly, but still an outperformance. When you think about some of those other sectors that could catch up, what names specifically are you thinking about there?
Well, I mean, you were talking about the energy sector earlier. You know, the fact that oil is coming up a little bit here was not part of our major thesis in the near term, but the fact that a lot of those stocks are not even pricing in where oil is now, I think that there's some value there. And I think even though they run over the last couple of years, you still see some places where we're going to have a longer term tail on conventional oil production and gas production for a longer period of time than I think we were building in a couple of years ago.
So that's interesting, because I was going to make the point that you look at sort of this non-reaction that we've seen in the actual oil market to some of the supply news that we've been getting over the past couple weeks. You're saying that there's still catch up that these energy equities have to do even beyond what's actually happening right now.
If you don't think that any bump in prices is only a temporary bump, if you think that there is a longer-term fundamental story for energy, which we do, I think there are places where energy still has some value. So yes, I think that there are places that you can absolutely look in that sector. And I think that going forward, again, we've got a longer tail on a lot of this hydrocarbon production that people were thinking we're going to switch to renewables. The EV story is very good, but you still have to have an energy infrastructure that you can plug your car into, right? So you still need to generate electricity. You still need to generate those joules of energy that people talk about are still very important. And I think that that's going to have a longer tail.
What is the efficacy of share buybacks right now? I get it off the bottom. You're supposed to buy shares back on October of 2022. It's part of Apple's story, clearly. But is use of cash, share buybacks, and dare I say dividend growth still part of the story?
It's absolutely part of the story. The question is, are you generating enough cash to buy your stock back without impacting your balance sheet in a negative way? And if the answer is no, then you shouldn't be buying your stock back. I think that there is a combination of factors that show up when you have stock buybacks and dividend growth, which is a healthy balance sheet and which is strong cash flow. I think when people get over their skis and start buying their stock back just to shrink the share count and don't pay attention to how that impacts the balance sheet, I think that's when you start to get into some trouble.
How do you identify that? You got a Bloomberg terminal or FactSet in front of you. How do you actually identify poor use of cash?
I think you look at the cash flow statement. I mean, that's part of that fundamental analysis that sometimes doesn't seem as important when the market is just running in one direction or another. But you go through and you see where are people spending their money and what are they spending their money on. And if there's a huge chunk of that, there's a huge chunk of that if you don't, if you're not paying attention to where that cash goes, when money was free, it didn't matter as much. Money is not free anymore. And I think there's a catch up that has to come with some of the higher interest rates. The corporations haven't had to really go out and borrow yet. I think that catch up is coming.
True story, and I say this with great respect to CFA's Romaine Bostic and Taylor Riggs. Did a tweet of them this weekend. I'm coming out of the level 2 exam. And like every exam, I'm certain I flunked, absolutely positive. I flunked. And the iconic question, this is a million years ago, was a cash flow statement workout using indirect or direct cash flow. I got it totally wrong, and in the last 5 minutes, flipped it. And I think it saved me on level 2 CFA.
You passed.
I passed. I'm honored to say I'm one of the people that what they say is 1, 2, 3. And it was the clouds parted. You know, the sun shone down. There was music, and
Well, I haven't taken the CFA, so I don't know if this is a question on the exams, but I want to talk about where the haven is in this market, because you rewind back to January 2023, coming into this year. This was supposed to be the year of fixed income, the year of the bonds. It's arguable whether that's played out. When you look at the next 6 months, you have interest rates maybe biased to go higher from here. Jerome Powell made clear 2 or more hikes coming down the pike. Is the haven in the bond market, or is this a situation where you could look to some of those tech stocks?
I'm not sure I would call the tech stocks a haven here. I think that I would look at the bond market if you want that stability, right? So if I can lock in 5% for 2 years, whether or not that's best for every investor is not going to be the case. But for some people, especially who have not been able to invest in fixed income over the last decade or so, there is a stability in being able to count on those returns that we didn't have for a long time. So there is a competition there. The tech stocks have obviously blown that out of the water this year. And so that competition looks like bonds have lost and stocks have won. But if you really have a longer term perspective where you're matching a liability going forward, there's nothing wrong with saying, hey, 5% for a couple of years is pretty good. It's the longer end of the bond market, which is still lower, which we're talking about that inversion earlier, that becomes a problem because you can't lock that in for more than a couple of years right now. And that's where the bias seems to be, that the expectation is that rates are coming down. We would question whether or not rates are going to come down as fast as the WIRP function is showing you on your Bloomberg.
I mentioned that on Friday as well, a new WIRP function, and it shows a different picture than what we're hearing from a lot of our guests. Sarah Hunt with us here for the hour, Chief Market Strategist, Alpine Saxon Woods here. And, of course, a lift to the market, and quite a lift on Friday as well. Looking at the 10-year yield, 3.85%. Standard & Poor's, I'm going to call it flat. Bloomberg Surveillance, good morning, everyone. On radio and television, we reset for you. Katie Greifeld with us, not Bramo, not Farrow. Greifeld with us, and you actually know the market closings today because it's Monday. I have no idea why we're doing this, but all the fancy people are away. They're, you know, sitting large and all that, and the staff's working, and we're working because there's a lot of news flow. When did the markets close?
The markets close. The equity market closes at 1 p.m. The bond market follows about an hour later at 2 p.m. It's one of those interesting days where the two markets aren't aligned. I think most recently this happened around the Easter holiday. We actually had a jobs report, but I don't believe the equity market ever opened.
Yes, I worked Good Friday.
Yeah.
Yes,
actually,
I did.
yeah, I watched you.
Oh, thank you.
Yeah, with my nephew. But the futures were open, so that was kind of fun.
Yeah, well, it's a strange thing. And again, all of this culminating towards a jobs report. On Friday, I've barely looked at it, Katie, but the bottom line is we're well above 200,000.
Oh,
I mean, you know, I don't understand how we can be restrictive with a change in non-farm payrolls of 225,000 as a survey. That's a boom year.
I mean, the question I'm excited to ask later on in the program, especially to Ellen Zentner, is this okay? Do we need to crush the labor market if inflation is coming down? I know you think about, okay, the path to 2%, we need to crush the labor market to get to 2%, but does that still hold when you think about the past 2 years of data that we've gotten?
Well, we'll see. What we know is it's been a resilient market. If you're not in it, you've really fallen behind after the difficulties of 2 years ago. On Washington, on the policy of the nation's capital this 4th of July, Isaac Boltanski, BTIG, coming up. On this Monday, Bloomberg Surveillance, good morning.
Was going to keep rate World Cup. This is a 3
as the economic picture does.
The OK is getting ready to make this decision.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. Fenway Sports Group has become a $10 billion global powerhouse. CFO Julie Swinehart tells Tom Keene how she's helping the company raise its game.
Winning's at the core of everything we do here, and the balance sheet is so important to the success of the team.
Watch Chief Future Officer Wednesday on Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The moment news breaks, no one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
China has been preparing for war with us for decades, and the way we have to deal with China is not look at it tomorrow, because if we keep waiting to deal with them tomorrow, they will deal with us today. We have to deal with them diplomatically, we have to deal with them economically, we have to deal with them militarily.
No rest for the worry. Politicians this 4th of July weekend kissing babies, appearing on the Sunday shows on Fox News Sunday. Presidential candidate Nikki Haley, which goes to the August presidential debates as well. It's already a full and complex political season. We welcome you on radio and television on a Monday, holiday-shortened work week, holiday-shortened Monday here. But we are here with terrific news flow, a little bit of China weaker news flow. Renminbi, I'm going to call it 7.25, not much reaction there. Oil up off Saudi Arabia and Russian news. Brent crude 75.81. That's a modest move here over the last 72 trading hours as well. Bremer off, Farrow off, Greifeld in, Katie Greifeld in with me today. And Katie, this is one thing I was really wrong on in June. I thought we slipped into July in Washington, and we just don't. It's busy.
It is busy, yeah. There's a lot of moving pieces here, both domestically with, of course, the Supreme Court decisions and also internationally as well. Looking forward to Treasury Secretary Janet Yellen's trip to China.
In the old days, let's focus on that. That was broken by Emery Horton and I believe Jennifer Jacobs. I can't remember exactly, here by Bloomberg a number of days ago, and now very much confirmed as Secretary of Treasury Yellen will travel to China. Isaac Boltansky joins us right now, Director of Policy Research at BTIG. Isaac, were you surprised that Yellen will travel to China?
So I think that the simple answer to that is no. And here's the reason why. What we've seen from the Biden administration is this concerted effort to keep tensions with China range bound effectively. So whenever there's a negative headline, you can almost bet with certainty that there's going to be a positive headline that follows. And so we've got this headline now, and the Treasury Secretary will go, and hopefully they're productive talks that, ensure that there's a commitment to continue talking. But that tells us that something negative is going to follow. And I really think that what follows are these investment restrictions that we've been talking about for the past few months. Some folks call them the outbound CFIUS restrictions. And I think that we've got to think about this as an ebb and flow in terms of the geopolitical tensions.
And this, of course, the timing is interesting. Of course, Yellen expected to make the trip just 3 weeks after Secretary of State Blinken visited China. And if you look at some of the reporting, quoting senior Treasury officials off the record, said that the goal of this trip is to seek to deepen and increase the frequency of communication between these two countries. When you think about this trip, what would a win look like for the U.S.?
I think that right now the bar is pretty low. I think it's that whenever they can leave the room agreeing that they will continue to talk, that is a win right now. It's difficult to see there being much more in terms of tangible mile markers we can look at. Rolling back of tariffs, for example. Those types of things aren't anywhere near being on the table. They're not even in the room. So at the moment, really, the bar that we're looking for is just making sure that after each one of these successive meetings, they're still willing to talk, they're still willing to travel.
Well, we'll find out soon enough, of course. Treasury Secretary Yellen expected to visit between July 6th and July 9th. Let's focus stateside, though, because it was a hefty week last week of Supreme Court decisions. One of the headlines there, of course, the Supreme Court basically threw out Biden's student loan relief plan. When you think about the ramifications for that on Biden campaigning for President Biden, the candidate, what does this mean in terms of him trying to sort of rally those younger voters?
Yeah, look, I think if we even just view this through a politically craven lens, the young voters 18 to 35 were the ones who stopped that red wave from coming during the midterm elections. They are a vital, absolutely vital voting bloc for the Democratic Party. And that informs our viewpoint on what the president's going to do here. And so he lost in the Supreme Court, lost handily, all things considered, but that doesn't mean that they're done. And on Friday, after the close, he came out and said they are going to attempt to do student loan cancellation again. I'm not sold on that for statutory reasons, but here's what's really important. They came out and said they are going to do effectively this delinquency grace period, where for 12 months, if you can't make your payment on student loans, there'll be no repercussions. And that's a big deal, given that 20% of student loan borrowers are showing signs of being unable to pay once that restart payments hits in October.
On radio and television this morning, Isaac Boltanski with us with BTIG, a spirited conversation here. 4th of July used to be about kissing babies. Those days are gone. It's a battle to the first Republican debate in August. We are advantaged this hour with Sarah Hunt, Chief Market Strategist, Alpine Saxon Woods, joining us this morning. She is riveted to the political conversation. Sarah?
So the student loan issue, this has been one of the things that people have been worried about from a spending standpoint, right? So consumer spending has been very strong, but student loans have been essentially in abeyance since we started COVID. So the question then becomes, I think there were a lot of people counting on some form of relief. So how much stress is it going to put on if that relief doesn't come? If you stretch it out over 12 months, it's a lot easier than saying everybody start making those payments in September. I'm sure there are some people who have been budgeting for those payments and are ready to make them, but I'm sure that there are many people who have not. So the big question about consumer spending, which leads into earnings and leads into the retail story, is what's going to happen now if you have to start paying back some of those loans or if you don't? And does that make a big difference in terms of earnings? There's been warnings for some of the retailers on that specific issue. So I think that this is it's a big question, and how it gets resolved still seems to be up in the air.
Well, Isaac, let's throw that to you. When you think about some of the economic ripples that could follow, especially as we head into the 2024 campaign season, what's your thinking at this juncture?
Yeah, so the way that I think about this is the consumer spending side, I think, is fair in that you have 22 million or so folks who are going to be able to begin repaying in October. And that's $275 to $350 a month that can start going towards student loan payments that won't go to other things. But here's another data point from the Consumer Financial Protection Bureau that I've been thinking about all weekend, which is nearly 1 in 10 student loan borrowers are already delinquent on other credit products, meaning that, and I think we've seen this through academic papers as well, that some distressed student loan borrowers use those 3 years where they didn't have to pay their student loans to balloon their credit lines through credit cards, auto loans, whatever it may be. And so for them, I look at this 12-month on-ramping as really a reprieve, where it's clear that they will not have to pay their student loans. So my question, I'll push it back, is, are they going to suddenly say, well, now's the time where I need to start saving to pay my student loan off? Or will I continue to live at this pace, knowing that the Democrats are most likely going to promise even more student loan relief once we get on the campaign trail in January?
Isaac, thank you. Isaac Boltanski with us with BTIG this morning with a brief here, and particularly off the Supreme Court work. We'll continue with our coverage of the Supreme Court with our terrific Bloomberg law team and counsel. Bloomberg opinion is just outstanding on the legal status in Washington. There's a topic we're going to touch on here. Somehow I think we're going to touch on it a lot more. The Washington Post with a tour de force this morning is a brief on malaria. This is what I studied in school, so it's like homecoming for me a few years back. And all we need to know is global warming is here, mosquito territory is bigger, and we have a number of cases in Florida and Texas for the first time in 2 decades. That's shocking.
Well, that's the thing. It's domestic malaria. That means that mosquitoes in the U.S. infected these people. That's the thinking right now. Yeah. Typically, people travel outside the U.S., come back, and they bring malaria. Not the case with this current uptick. So we'll see how this continues.
Shannon Osaka with that at the Washington Post. I'll put that out on Twitter. It's a terrific primer here from Florida to Southern California on global warming and mosquitoes. This is Bloomberg. Good morning.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Bloomberg surveillance. John emails in from a fourth island in Italy. I didn't know there were 4 islands in Italy, but there are.
He's been to all of them, it sounds
It's like a north-south traverse of Naples. Like Naples is over the horizon, and he's like, I can't pronounce it anymore. John's scheduled to be with us at some point. I have no clue when. It's gone from holiday to sabbatical with John Farrell. Lisa Abramos, on the other, escaping for 3 fun-filled days. She's up in the rain on the Racket River.
No.
She's the only one I know that still uses a wooden canoe. It's some old LL Bean thing.
Yeah.
Portages it herself, and she can portage and do all of Long Lake in a long day. It's like forever. I've done it.
Can I tell you, I don't know what portage
Portage is you carry the canoe yourself.
Ooh, okay.
She's such a hitter up there. She can get guides to do it.
Yeah.
But she carries a canoe on her shoulders, and a portage can be like 35 feet or 80 feet, but it can also be 4 miles. She's tough as nails. I mean, you see it on TV.
Yeah.
It's the same thing. Anyways, Bramo's scheduled to be back, I think, before Farrell. I'm not sure how that works. Katie Greifeld with us. Really, like, it was a real yield exciting on Friday. I mean, you had something to talk about.
Great. Oh, yeah. I mean, we spent a long time on that Bill Dudley column from last week. Remember,
4.5% yields.
4.5% in all of Wall Street against him. So it was pretty good.
Sarah Hunt with us as well, sitting in for the hour with the equity markets. Really, really quite valuable there. And right now, we're going to look at the equity markets. We're going to do it with individual names. Where do you? I thought it'd be dead and boring. We'd skip this. No, there's news.
No, yeah, there's a lot of news. Let's start with Tesla, because a big move there. I believe currently somewhere between 6 and 7% higher. Of course, the news over the weekend was that it had record deliveries, delivering over 466,000 cars worldwide. That is outpacing Wall Street estimates. And of course, the story around Tesla, specifically around its cars, has been that it's been trying to push for more volume at the expense of its profit margins through cost cuts. It seems like maybe we can say that's starting to pay off.
Was this an earnings report or just an ad hoc unit report?
I believe it was a unit report.
It was just a sidecar report.
Yeah, these drop every couple of months over the weekend. Everyone gets excited, and you can see the pop in shares, even though you know, there's not a lot of people working today. And it's really giving a lift to the entire industry. Lucid, there is some news around Lucid. Citi resumed coverage of the EV maker with a neutral recommendation. Their reasoning for doing that is that the company's technology position has been validated by its recent agreement with Aston Martin. It did say, though, that the analysts there saying that near-term demand and their gross margin progression in the first quarter is challenged. So neutral, and that's giving a lift to shares up about 2.2%. Rivian also rising today.
I saw one on the street once.
Really?
Yeah, fancy.
They're okay looking.
I don't know. It went by me, and I waved. And
yeah, you do see them on the roads. Not as many as you do with Teslas. It feels like you sneeze and you see a Tesla. But Rivian, really, it seems like it's just following the news of the sector higher. The share's up about 2.5%.
Sarah Hunt, with his chief market strategist at Alpine Saxon, was before we went to Mr. Athey in London. What do you do when something's in vogue, like EVs or AI? How do you, as a grizzled pro, treat the next big thing? The guy at Vision Fund in Japan, the billionaire, SoftBank guy. SoftBank guy's gung-ho now on AI. All my radar's up when I see that.
Well, I mean, to the extent that we've already been using AI in a lot of different applications for a longer period of time, it's already been a theme. It just became I don't know how you would characterize it, but after ChatGPT came out, it became the theme, right? It also, I think, helped equity markets because we had a story and we had a hook that said, okay, we've got these things going on. This is going to drive markets. This is going to make things happen. You look for things that are tangential, but also involved with it, right? So you look for companies that are outside of the absolute media darlings. Look at
a sector or a stock.
Look at DLR, right? So look at some of the companies that do, or Equinix. Look at the companies that do data centers. You've got those servers have to be housed someplace. People have to pay rent on those servers. The more AI you have, the more you're going to have. So Digital Realty, Equinix, the stocks that are playing in the parts of the ecosystem that are very important to it being able to work are places that we can look where we don't think the valuations are as stretched as some of the other players.
Sarah Hunt, again with us here through the hour. Joining us right now, James Athey joins us, investment director at Aberdeen and far more Tots fan. I didn't book him for Aberdeen and all the stock chat. James, cut to the choice. You're in my beloved Tots. Are they going to lose Lord Kane?
Oh, Tom, I hope not. I hope not. That really would be a dampener on the summer. As I was just saying to you off air, I don't think any Spurs fan could blame him if he sought, top trophies elsewhere. But we're desperately hopeful we can keep him, and under this new manager, put in some performances in the first half of the season, so he signs a new deal.
What do you think of the new manager? John emailed me from some Italian island I can't pronounce, and we're trying to figure out Arsenal Tottenham at the stadium. What do you think? Is the new manager going to get it done?
Yeah, well, I mean, hope so. At the very least, what he's going to do is bring some entertainment back because, I've got a season ticket and have done for many, many years. And the last few years have been at times very difficult. So if he brings entertaining football back, at the very least, that'll make it enjoyable to be there.
The entertainment of the stock and bond market, and as somebody as institutionally as responsible as Aberdeen, what do you do at mid-year if you're behind the market? I don't mean Aberdeen behind the market, but the millions of people that just missed it. What's the plan at July 2?
I mean, you have to try and, the whole point of what we're trying to do here, long-term investment, and we're trying to apply the process, and we're trying to do that as unemotionally as we possibly can. So you can't allow your decision-making to be clouded necessarily by things which have gone on in the past. You run your analysis, and that leads you to make decisions based on where you think things are heading. And if you do that consistently through time, then you should generate consistent results and consistent outperformance, even if you have experienced a period where things have been a bit more tricky. And certainly this year, I found it incredibly tricky as we chop from one narrative to another quite violently. And then when we do start to trend, that trend is equally as violent.
Well, James, that being said, what emotion do you feel when you look at the 2s-10s curve, 109, 110 basis points inverted? What message does that send to you?
I mean, I'm reluctant to call it a better recession indicator than anything else. I know it's an easy criticism of economists to say that the bond market has been right more often than economists with respect to forecasting recessions, but it definitely tells you that the bond market is nervous about the outlook for the economy, and it's a stark divergence versus the message that we're getting from the equity market. So trying to narrow down the signal looking cross-asset actually gives more confusing messages than it does confirmatory messages. But to me, it does suggest that policy is already tight, and the tighter that it gets, the more that's just going to depress forward growth and ultimately forward inflation.
So we've seen some tighter policy in terms of higher interest rates, but the question really becomes, has that really tightened money flow? And there is, to the extent that it seems like there's been more liquidity rather than less liquidity over a period of time, there's an argument that that's been fueling the equity rally. There's another argument that the bond market doesn't have a lot of signals right now, and it's not the same as it has been historically. I'm always wary of those arguments because I think that a lot of those historical combinations do matter, but you had 15 years of interest rate suppression. So do we really have a tighter global credit situation? I mean, you have higher rates, so for borrowing purposes we do, but there's just been a lot of liquidity. So how do you think about that?
Yeah, I mean, it's very complicated, Sarah, it really is, because, what we learned from the post-crisis period was that liquidity provided into the financial system was not necessarily liquidity provided into the real economy. So you had asset price inflation and not consumer price inflation. And then post-pandemic, the governments really did become the transmission for market liquidity to become real economy liquidity. So the fact that central banks have been trying to withdraw liquidity from financial markets, but actually have been interrupted along the way, has indeed created this bounce in equity markets, or at least it seems to have coincided with a bounce in central bank provided liquidity. But when you look at some of the broader kind of more traditional money stats, you still see a picture which is declining year-on-year money growth, whether it's M2 in the US, M3 in Europe, or M4 in the UK. All of those monetary aggregates are telling you that real economy money is tighter today and is getting tighter.
So then the question becomes, do we stay tighter for longer, right? Because that's also been the question. The markets are pricing in, or at least according to the Bloomberg function, WARP is pricing in the fact that we're going to start cutting rates in a 6-month period. Do we think, I think that that's going to be tough for the Fed to do, but what do you think about global liquidity going forward? And what do you think about what the Fed and other central banks are going to do? Are they going to be able to hold rates stronger, or do you think that they are going to end up cutting rates?
Yeah, ultimately, I think they will end up cutting rates. I think history doesn't provide a lot of examples or analogues for where policy has tightened as rapidly as this. Unemployment has been at very low cyclical or even secular lows, and we've managed to find a sort of stable equilibrium in that situation. It doesn't tend to be the case. It tends to be the case that unemployment goes sideways for a short while at the lows, and then for one reason or another, it rises, and that very much is the backbone of the cycle. So I was looking at this in the UK because it's such an extreme example, and I use this through trial and error. I just use a 600-day lag between those broad money growth aggregates and headline inflation, and that 600 days suggests to me that given where we are in terms of central bank policy right now, we'll be seeing 0% headline inflation in the UK in kind of 18 months' time. Quite how far the Bank of England gets with its hikes before that data starts to show that progress is obviously difficult to say.
Very quickly here, we got 30 seconds, James Athey. If we get that large first derivative move in disinflation that you're talking about, Ed Hyman's talking about, many others are talking about, what do equities do?
Well, equities will find a way to turn that into a positive. I think disinflation without a downside in growth, without an upside in unemployment, is the Goldilocks soft landing narrative. I think that's what equities are trying to price at the moment. I think the reality check comes for equities and generally does cyclically when unemployment starts to tick up, when we get that first very weak or negative payrolls. I think that's when they have to start to think about what that means for the earnings outlook.
James, thanks for the brief. James Athey with us there of Aberdeen. They're on the equity markets and the future of the tots as well. That was my English football moment for the day. I miss Pharaoh so much.
I can't help.
Did you watch the Formula One Grand Prix this weekend in Austria?
I did not.
It was very Austrian. I looked at the entire. They had like 300,000 people. No one there bought the 97-year Austrian piece. It's down 70%. I would know that because I bought it at the top. Standard & Poor's this morning, it is flat. Good morning to all of you on Bloomberg Television and Bloomberg Radio. Katie Greifeld in for Lisa Abramowitz and Jonathan Farrow. It is a Monday of substance. There's no other way to put it. I just thought that we would sort of nail in here. Do you know how many hot dogs America eats on 4th of July?
I should know because I know you put it in the chat at some point, but I don't know, actually.
I don't believe the number, but it's 150 million hot dogs. I hope that's over like the extended weekend.
Yeah, not in all one day, I would hope. That's a lot of hot dogs. I'm not a huge hot dog fan.
I love the Mike's mustard commercials.
Yeah.
With the Yankees baseball.
Uh-huh.
Do you put ketchup on a hot dog?
I don't eat hot dogs, but if I do, I would do mustard, I think.
Bramo eats hot dogs.
Mustard and sauerkraut.
There you go.
Thank you.
That's
you don't
good.
put ketchup on, right?
No.
Yeah, Mike's Mustard of New Jersey. They're really big on this. Like,
yeah.
Afterthought uses ketchup on a hot dog. It's ridiculous.
You can't put
it's
red
un-American.
on red. I don't know. I'm weird about colors. That
It is.
Yeah.
Thank you.
Yeah. You need the contrast. With
Say
the
good
mustard.
morning to Zweigel Hots, White Hots and Red Hots up in Western New York. The best.
Mm-hmm. Mm-hmm. Maybe I'll eat a hot dog.
When was the last time you? Wait a minute. You went to Haverford and they didn't serve hot dogs,
No,
right? It was like tofu dogs.
Yeah, it was big chicken and stuff along those lines.
Okay.
I had a lot of quinoa in college. That was.
I didn't know how to pronounce it until I was lectured on it. I had to repeat it 10 times as well. We're going to continue. Sarah Hunt with us here from Alpine Saxon, and also coming up, Jim Bianco. Ellen Zentner will join us as well, and really important in the 8:30 hour on equities in the derivative space. Anna Hahn will join us in Wells Fargo. Really looking forward to that. What a strong day. The team didn't mail it in today.
No, I know. A lot to talk about.
The only one that's here is Amy. This is Bloomberg. Good morning.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The major problem here is that, China's moving off its old economic growth model, but it hasn't moved comfortably into what's next. You're seeing much slower growth overall. You're going to see a long-term structural slowdown in the Chinese economy, and that they haven't truly prepared the world for that or their people for that.
I have an offspring in China. Cash flows over in China. And I was raving to him this weekend about Leland Miller, co-founder, CEO of China Beige Book. He's just the absolute best on the granular nature, getting away from the hype on China. We welcome all of you on a Monday. Katie, help me here. 1 p.m. is equities or bonds close?
Equities first, bonds later at 2 p.m.
Ridiculous. Can we just get this?
Can we standardize it?
I get so upset at fancy executives on Wall Street.
Mm-hmm.
They're out in the Hamptons. They're doing horseback riding in the mountains of New Jersey. Martha Stewart, they're up in Connecticut. All the fancy people are off today, and the staff is working. It's un-American.
I know. Well, they're working from home, probably. They have the laptop up.
They're working from home. It's not the same. They've got a staff. Name the institution, the New York Stock Exchange. Everybody has to come in except the fancy people.
Mm-hmm.
It's an outrage. Red and green on the screen here. NASDAQ up a little bit. The VIX 13.81 as well. The data check, I want to look at bonds here, 4.95%. Seriously, folks, 2-year yield, we're on the 5% watch. What will that do to money market funds here as well? 10-year yield, 3.86%. In the headline number today, massive curve inversion, 110 basis points of curve inversion. That's I'm going to call it a record wide as well. Sarah Hunt with us with equity strategists. How do you interpret a curve inversion? What is maximum financial media talk? OMG, 110 basis points. What's it translate to over to an equity analysis?
It translates into a very challenging environment for anybody who is lending long, because you are not getting a good, you don't have as much room. If you're a bank, that's not helpful for your net interest margins at all. And to the extent that it's supposed to presage a slowdown in the economy and or concern about growth going forward, I think that inversion, I mean, Michael Darda was on last week and had some really good stats on how long it can stay inverted and when it finally starts to matter. Yeah. And the argument has been now, well, it doesn't matter, but it's only been 11 months that it's been inverted. And that's a very wide, 7 months to 25 months, that's a very wide spread in terms of how long it starts to really affect the economy overall. So I think that there's really a question as to what that's signaling right now. But I think that it is not generally a good signal.
Darda's, in his newsletter, like Sunday or Saturday, thank you, Michael, for mentioning the show and, you know, what we talked about and all. There's a photo of him sleeping on a couch, like he's like completely. Sarah, Darda's like comatose. He's like sleeping. Are you like relaxed in this market? Can you take like the Alpine Saxon nap?
Well, I think that his style is more laconic, so it's possible that he's not just relaxed. He's relaxed.
With dogs like that, he's very laconic.
But I think you can't take a nap. I mean, you can never take a nap in the equity markets. I think the problem is that with this striation between what's run so far in technology stocks and where most of the market has been all year has been a surprise to people. And I think the question really becomes what happens to earnings next? Because are we going to get the ice of Mike Wilson, or are we going to stay with higher earnings, which is what the market's pricing in, because then the multiple isn't as much at risk. But when you have a big multiple expansion, if earnings come down, then you start to see, oh, the earnings are coming down, now the multiple contracts. That's a problem. That's a bigger problem for
Absolutely
equities.
Brilliant. Sarah, thank you so much for being with us for this hour today. Speaking of someone who has not slept in 3 years, Enda Curran, with huge courage, ran the fort in Hong Kong. He is now our global economy reporter and student in Washington as well. Enda, thank you so much for joining us today. Enda, Yellen to China. Who will greet the Secretary of Treasury?
We don't yet know the exact details on which officials will greet her, Tom. Probably her counterparts at that level in the economic space. You know, it's unlikely that she would perhaps get to a meeting with President Xi, for example, in the way Secretary said Blinken did a few weeks ago. Remember, the guardrails for her kind of purview are less about trade, it's pure about the economic stuff. So she'll probably be focused on what's happening in China's economy, what's happening in the US economy. And the messaging from the Treasury has really been about managing expectations. They're not talking about any kind of a breakthrough on this. They're talking about improving communications between both sides and maybe looking for some areas where there can be cooperation. So no, not really a breakthrough meeting, but certainly a continuation of the trend of an attempt to stabilize relations in recent weeks.
And Enda, looking at the reporting, as of now, it looks like, though, she's not expected to meet with Chinese President Xi Jinping. Is that correct?
Yeah, I mean, it's probably, we'll have to see how it plays out, but it's probably unlikely to happen. It's more significant that she's going in the first place, Katie. Remember, this meeting has been talked about for so long and has been derailed by various incidents over the past year or so. You had Nancy Pelosi's visit to Taiwan, then, of course, you had the balloon incident. But it's back on track now, and it's speaking to this idea that they are trying to stabilize things. And remember, Ms. Yellen herself is pushing this idea of not decoupling, but de-risking the two economies. Now, you can argue what the difference is, but that's the line she's pushing. Nonetheless, though, there might be some pushback against Ms. Yellen as well. The Chinese side may ask her, what about these investment and export controls that your government is talking about imposing in recent weeks? So there are certainly grounds for some tension, even though this is meant to be a visit to stabilize things.
And then to talk about what this relationship used to look like, specific to the Treasury Secretary. Of course, this is Yellen's first trip to China as Treasury Secretary. But as I understand it, at one point, the Treasury Secretary used to visit China every 6 months or so.
Oh, yeah. I mean, pre-COVID days, this was pretty routine dialogue. They had the strategic dialogue, which happened every 6 months or so. Like you mentioned, officials from either side would go to either capital where they would meet and sit down and discuss the economic events of the day. That was a legacy from the Hank Paulson era. Now, of course, the critics would say that that was a period when the US should have been much more forceful in some of the economic issues around, we'll say, the access to China's market, protection of intellectual property, and all the rest of it. They allowed those issues to build up in that period. But nonetheless, there was certainly a better framework for cooperation back then than there is now. We're a long way from where that was. And that's why this meeting with Yellen, the Treasury, are only managing expectations that this is only about getting things back on an even keel, trying to stabilise relations, rather than any kind of substantive breakthrough or agreement on any of the major matters, Katie.
And outside of what falls under Treasury Secretary Janet Yellen's purview, let's talk a little bit about some news that we got this morning that China is going to impose restrictions on exporting two metals used to make semiconductors and other electronics from August 1st. It feels like the chip arena has really become the battleground for a lot of these U.S.-China tensions to play out.
Oh, yeah, the high-value add technology is really where this competition comes down to. AI, quantum. I mean, the rest of the broad manufacturing story, that ship has sailed, but where the US and China are now clashing is on the race from where do you go from here, and that is, as I just mentioned, semiconductors, quantum computing, AI, and everything else. Now, it's interesting to see that China is talking about these export controls. I'll have to see more details on exactly what they're talking about, but it could be interpreted as being a kind of a tit-for-tat in response to what the US have been doing and what the US is expected to do. More export controls expected over coming weeks, of course, on investment into key technology sectors in China. But it shows China has some room for retaliation too.
And is this your first 4th of July weekend in Washington? Is this,
in the US,
it's like you realize the colonies won. That's what this is about. The colonies won. Okay. And as we've been talking about, only mustard on the hot dogs. Okay, no ketchup on the hot dogs. And a current.
I'll bear that in mind, Tom.
Bear that in mind. Ben's Chili Bowl, you'll love it. U Street. And a current there on his way to Ben's Chili Bowl after his work today in our Washington office. Just a jewel. I can't say, Katie, enough about, seriously, like I get emotional. Mm-hmm. The dedication of our Hong Kong team under maximum stress was just extraordinary.
Well, I'm delighted that Enda is now in U.S. hours because I get to talk to him more. So.
Yeah, it's great.
Yeah.
Sarah Hunt with us as well, listening to the Chinese discussion. How does Chinese affect American portfolios? Can we impute disinflation from China? Does that change the revenue stream, the revenue analysis of equity portfolios?
I think that the big question with that right now is if you're going to have onshoring, does that take away some of that disinflation that we were importing? Because lower goods countries and lower cost countries, when we were manufacturing a lot of things there, that brought disinflation in. If you're going to start building things in the U.S. and in places where the costs are higher, does that take away that disinflationary impulse?
Thank you for bringing that up. It'll be one of my charts for Q3, manufacturing in America. Stay with us. Bloomberg Surveillance.
The moment news breaks, no one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter
better.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I really do think that those recession calls will continue to be misplaced.
I've got a fairly bullish forecast for inflation.
The disinflation narrative is going to start to become a bit more established.
A lot of the data that we're placing our optimism on is backward-looking, not forward-looking.
That sticky inflation is still the main concern.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Our strongest holiday Monday since I've been at Bloomberg. A superb hour ahead. Jim Bianco will join us. Ellen Zentner will join us for the entire hour, and we do it with real significant changes in the bond market. Bramo out, Farrow out, I'm in, Greifelder here, and Katie, I'm sorry, I'm on a 5% watch on the 2-year with new record curve inversion.
Can I talk about the 10-year a little bit? Because I was just fiddling.
Bramo would. She'd do exactly the same.
She would. Okay, I'll channel
Tom,
Lisa.
you know what you're talking about.
Let's talk about the 10-year. I was just fiddling with some charts. We're at 3.86% on the 10-year right now. We came into the year at 3.87%. We are almost completely flat on the 10-year yield with about a 75 basis point range. Just incredible volatility to go nowhere.
And I'm gonna do this right now. Bring me up if you would for TV, and I'll mention it to radio as well. The 2-year annualized return on the equity markets, because everybody's going nuts about the 6-month track record, the NASDAQ, Apple, and all that. If you go back 2 years, 24 months, and you look at the annual return over those 24 months, it's like low single digit. SPX 3.4%, Dow 1.9%, the industrials, NASDAQ 100, 3% as well. I mean, forget about the hype of the last 6 months. It's been, post-pandemic, we've noodled along.
We've noodled along. I love that term. Well, you think about just
CFA.
how ugly 2022 was. I mean, when we think about the rebound that we've had since October, it's easy to forget. But We were down double digits and then some on all the big benchmarks last year. It'd been a while since we've seen that.
We're not going to brief this hour. Were we briefing this hour?
We're not.
I don't know. We're not briefing, but we're going to do this because it's important. We miss John Farrow. He's on his 4th island off Italy. I think they're all off Naples. I didn't realize there were so many islands off Naples.
Yeah.
Naples did well in football this year. That's soccer in Farrow talk.
Going to write that down.
And yeah, write it down. And we got ISM manufacturing, prices paid, employment, new orders, even awards, total vehicle sales. And the answer is these are still sort of soggy numbers. I mean, it's not morning in America when you look at the first look of June here on July 3rd.
Yeah, no, it's definitely, I mean, you look at U.S. manufacturing PMI expected at 46.3. That is solidly below 50. So not great there. But then you think about other parts of the economy that are still doing really, really well, just defying the messages that we're getting from the yield curve.
Our schedule here, to be quick, is markets closing at 1 and 2. I don't know which.
Equity and
then bonds. Fine, we're going to do that. Holiday shortened workday or whatever it is. And then we go on to the jobs report on Friday. And I feel like the earnings season starting the 14th, I don't have a clue what the jobs report's going to be. I don't have a clue what earnings season's going to be.
It's going to be strong for the first one, the jobs report. The earnings report, what we're expecting this season, I'm not sure.
Yeah.
And it seems like neither is Wall Street.
Data, -5 here on SPX, a little bit of sogginess, but it's got that Monday holiday feel to it. The VIX 13.80%. The 2-year space I mentioned, 2s, 10s, 109 basis points of shocking inversion. Very quietly, the real yield elevated over the last 4 days from a 158 out to 1.62% as well. This is a joy. Joining us for the entire hour, Ellen Zentner. She is chief U.S. economist at Morgan Stanley. And Ellen, I'm going to join. You were like 15 when you came out of Texas and joined us on Bloomberg. And it was like, a few years ago. And you are expert on the American consumer. What is the state of the American consumer?
So I think if you look at the consumer, you have to look at it by income group. And I think we've been long talking about those lower income quintiles that have been dealing with having gone through their excess savings, still dealing with high rates of inflation, and labor income that's been slowing. But you look at the upper income household. So look at John Farrow on his 4th island in Italy, as you pointed out.
It's just
the appetite is insatiable.
Wait, he sends me these photos. He spent the entire trip on a boat.
Yeah, well,
and it's not like it's like a George Clooney boat.
Yeah,
it's got the wooden thing going. The girls draped over the side, the whole thing. I mean, it's unbelievable. That economy's holding us up.
Yeah, so it's look, the U.S. is always a services economy, the bulk of it. And you've got the upper income quintiles where their total spending is 40% of all consumer spending. So if the wealthy are out there spending, and when I say wealthy is middle to middle upper income households and above, then it masks really weakness at the lower income levels. And so what it looks like is that you've had this slowing in consumer spending, but resilience, but it's being driven, it's lopsided. A lot of the economy right now is lopsided, being driven by certain sectors, but not others.
You made headlines 72 hours ago. You moved a Fed rate hike forward. I don't do the parlor game like John and Lisa do. Katie does it 24/7. But link that into the basic idea that we're aggregating all of our economic analysis. And you just told me with consumers we partition. Do you aggregate to get to your calls, or are you looking at 2 or 3 Americas out there?
Yeah, so it depends on what side of the, do I have one? I have one foot in the equity side, right, of the markets. I have one foot in the fixed income side. On the equity side, equity investors really care about who is doing the spending, because you want to look then at companies that cater to those income groups, and where and what are they spending on. On the fixed income side, it's just, is the economy growing well above potential? Are we creating inflationary pressures that the Fed is going to have to respond to? And so that's where I look at things in the aggregate. So it's just an interesting dichotomy. And this is something that we started doing after 2008. After the financial crisis, I really started digging into spending not in the aggregate, but by income group, by ethnicity, by age group, because it can differ really widely.
Well, let's fold the labor market into this conversation because, of course, Friday's jobs report is the big event to watch this week. The unemployment rate expected to fall, actually, to 3.6%. How sustainable is that at this point?
So I think the unemployment rate, had this big pop higher to 3.7% in the last month. It had been really sticky around 3.4, 3.5. Whether it's 3.5, 3.7, 3.6, it is an extremely low unemployment rate. And the big guess has always been, well, it's really low. Doesn't that mean a super tight labor market? But it's questionable as to exactly how tight is the labor market. A lot of these open positions that aren't being filled are what we would call just sort of phantom positions, phantom openings, where companies are it's very easy to list jobs. It's very easy to keep that opening out there in case you fill it. And we're seeing that a lot of those phantom openings are being closed. But look at how low the unemployment rate is, and inflation has been coming down, right? It's sticky, it's high, but it has been coming down. So we've been able to do that without killing the labor market.
Right. And that's exactly what I wanted to talk about. We've so far been able to bring inflation down without killing the labor market, as you say. But when you think about 2% and still how much distance there is to go there, maybe we don't need to kill the labor market, or maybe we do.
Well, yeah, and what is killing the labor market? I mean, of course, nobody wants to, you hear this, oh, well, Chair Powell and the Fed, they need to or want to kill the labor market to bring inflation down. No, they absolutely don't, right? They, of course, would love to bring inflation down in an orderly way and do it where you have more sustainable rates of unemployment without a lot of high inflation. But look, we're all guessing, and I think Chair Powell has been a very humble leader, that we don't know exactly where full employment is or what is that ideal level of unemployment. What we do know is that he would like for inflation to come down more quickly than it is. Housing is a key element of that if you want inflation to come down more quickly. And a very tight labor market with very strong income growth is going to continue to put upward pressure on that, because guess what? Kids get out of college, it's a great unemployment rate, they can get a job and get paid enough and go and get an apartment. That puts more demand into the system because you are increasing household formation. You need to actually get household formation to shrink if you're going to bring pressure off of home prices and rental prices. You've got to get all these kids to move back in with their parents. Tom, they're going to be living with them forever. So that's one of the elements, right? People consolidate.
Katie, help us. Are you moving back in?
I would love to.
Oh,
honestly,
great.
That sounds really good. But I think I've found another household at this point.
Is there a theory right now? I mean, it's center there. They're all lined up with Sarah Ice, and the Ducks are all lined up, and I'm in search of a theory. Is any of this theory in the textbooks, or are we just literally, I said to Mohammed Al-Arian today over at the University of Cambridge, great graduation ceremonies at Cambridge with Dr. Al-Arian, and I said to him, I just said, it's all this ex-postedness waiting for the next data point. Is that all we got right now?
Look, the Fed is data dependent, so we have to be data dependent. There's no forward guidance, and this is
There's no forward guidance.
Well, this is something I thought was interesting that's emerged. So you have Governor Jefferson, who has been nominated to be vice chair, and he has already begun posturing as though he's vice chair. But it's a very important executive position on the FOMC. So you have Chair Powell saying, look, data dependency, we've not made any decisions. We're going to come in to make a decision at every single meeting. Yeah. That means a lot of volatility, right? A lot of guesswork. You have Vice Chair Jefferson that came out not long after he was nominated and said, this may be a time where forward guidance could be good, could be useful, right? So starting to kind of put his toes into the water, dip his toes in and say, well, maybe this is good. Though. Yeah, but the vice chair voice is very important. Yeah. And I think it underscores the kinds of debate that they're having around in the boardroom, right?
Now, you're with us for the hour. We're going to come back and talk about the jobs report on Friday, because I think with all this inflation hysteria, Katie, the labor discussion has been put aside. I'm glad you asked about that earlier. Katie Greifeld in for Lisa Abramowitz and John Farrell. We are thrilled that Ellen Zentner joins us for the entire hour. Lots of economic data today, 10 o'clock. We'll talk about that here in the next couple minutes as well. The VIX 13.80. Standard & Poor's 500 down 3. I'm going to call that a fractional percent. We say good morning on Bloomberg Radio, on Bloomberg Television. Katie Greifeld and Tom Keene on a Monday. Market's closing at 1 or 2. I don't know which. Doesn't matter. Get your orders in early and often. As well, Ellen Zentner with us. And let us continue here on ISM manufacturing. I never really looked at it. I didn't care. Farrell says, don't be an American dummy. It matters. The ISM surveys are under 50. Does that signal contraction?
So at a level of 46 about where ISM is, historically that is a recession level. Now, under 50 doesn't mean recession, but generally you can start to get to the 48 level, and that tends to be sort of the average historically where you're getting into trouble. Now, the thing about ISM, and maybe this gets into sort of the boring nitty-gritty that economists get into, there is a component within the ISM called delivery time. So if I'm super busy and I'm trying to catch up on all these incoming orders and produce them, my delivery times are going to slow down. That actually means that things are tight, and that's a good thing. When delivery times become better, it means that, well, I've got, I'm producing things really quickly. I don't have a lot of incoming orders, and I can get them out the door quickly. Because supply chain disruptions meant that my delivery times were really slower because I just didn't have a whole lot of business. That actually was supporting ISM at that time. And as delivery times have increased because supply chains have normalizing, that's actually depressed ISM. Now, so at 46, that's not a good level, right? Tell me if you're confused yet. So this is what economists are good at.
I've been confused with you for years.
This is what economists are good at.
We're going to be saved by the break. Ellen Zentner with an ISM lecture. Where's Farrell? He would have taken notes. He would have loved that. Stay with us. Jim Bianco, president of Bianco Research. What an 8 o'clock hour.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
News breaks. No one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
Our call is that the Fed would probably stay in and around, the current levels for the remainder of the year. It's not out of the question that they raise rates by maybe 25 basis points or even 50 basis points by the end of the year. But, that's only going to really bring the recession, forward, if you will.
Subrata Rajappa, SocGen, that was really, really timely. Look for that with all the dynamics that SocGen brings in derivatives and fixed income as well. And that really sets up the debate here. Katie, as you mentioned, Katie Greifeld in for Bramo and Farrell. And as you mentioned earlier, the Bill Dudley piece was the tone setter for last week.
I mean, it arrived at a perfect moment because it feels like we've been sort of stuck in this range on the 10-year yield. Again, basically flat for the year with a lot of volatility. As to whether we take a leg higher or maybe we've seen the peak, that is the debate in markets right now. And Bill Dudley coming firmly out on the side of higher yields.
There are many people here talking of these themes. Ellen Zentner is with us with Morgan Stanley for the entire hour. We're going to devote a huge part of the back half hour to her view forward. But we're going to have Ellen join now with Jim Bianco. He's president of Bianco Research, hugely followed on the street. And what I find is it's a smart note, always, of course, that's Jim Bianco. But there'll be one sentence that hits you over the head. We get that now from Jim Bianco, where he talks about inflation coming down to that before level, and then it will reverse and drift higher. Jim, state the theory. How will we get to 3%, then drift higher?
Well, it's the base effect. Last year, June of 2022, we had one of the highest monthly numbers ever at 1.2%. You may remember gasoline prices were $5 a gallon a year ago. We're going to drop that off and we're going to replace it with a much lower number, something like 0.4 or in that range, and that'll bring the year-over-year inflation rate down to 3% for June. July of 2022 was 0. August was 0.2. Those numbers are going to be easy to jump over. And then if you start looking at September, November, December, you got 0.2s, 0.1s. Those numbers will be easier to jump over. So we should bottom at 3% and start drifting towards 4%. Now, I'm assuming no major downturn, no kind of crisis that comes along, no heating up of the war. That could change that equation. Yeah. But if the inflation rate bottoms at 3 and starts drifting higher, the Fed's going to find this unacceptable. And that 2 rate hikes that we have priced in for the rest of the year will happen, if not 3.
Jim, you're such a student of history. Is the Fed finding it unacceptable because they're wedded to a return to the great moderation? Or as Bill Dudley said last week in his Bloomberg Opinion essay, this is a society, a country, a nation, and the Fed that has to get used to a permanent higher rate regime?
I don't think the Fed's quite with Dudley that they need to accept a higher permanent regime. I think they look at the 2%, and I think it comes back to May of last year when Chair Powell was in the White House, in the Oval Office, and President Biden pointed at him and said, America, this is the guy that's going to bring inflation down. And he's taken that very seriously. He has stated over and over again that their goal is 2%. He has said that without getting inflation down, you don't have an economy. So he's dead serious about trying to bring it down, and he should, because prices for the last 2 years have largely been running faster than raises. And so on a real basis, especially people that live paycheck to paycheck, they've been falling behind, and that has to be rectified.
And as such, we've seen expectations for the terminal rate definitely move higher over the past week or so after hearing from Powell that commitment to keep fighting inflation. But let's talk about the neutral rate. Has your calculus for where the neutral rate could be changed at all?
No, it hasn't changed, except that I'll go with what the Fed says. The neutral rate is somewhere around 0.5% above the long-run average of inflation. Now, of course, we could argue to the cows come home, what is the long-run rate of inflation? Is it 2? Is it 3? Is it 3.5? I'm more in the 3 to 3.5 range, which means that neutral is 4. And then Chair Powell put a little nuance on it. He said the entire yield curve has to be above the neutral rate, not just the funds rate. So some of the rates, like the 10-year note at around 3.85, are not quite there. And so that would suggest higher rates. So I am with Bill Dudley on that rates are probably going to continue to drift higher.
It feels like a Fed Decide show. We got Jim Bianco and Ellen Zentner with us. Ellen, I want you to ask a question to Mr. Bianco. Try to be nice. But Ellen, I want to get an observation from you first. Is this a Fed that has to make, as John Taylor of Stanford would say, this is a Fed that has to make a regime shift away from the silliness of 1.x run rate on the Fed funds rate?
Well, I think this is something that is going to underscore how much they have to go back to the table, as they said, every 5 years, and taking a look at their entire framework of how they conduct monetary policy and things like, are we at a longer run, higher neutral rate?
Are you with Clarida on this,
Are we
and
going
Olivier
to,
Blanchard and others?
I think that these things are evolution, not revolution, when they make changes. I don't think that they're going to change the inflation target, but I think they can fudge around it like some of the central banks and have a band of uncertainty around that. But Jim, I want to ask you, when you think about how long the expansion will last, we're going to have a downturn at some point, and probably inflation will still be higher than goal at that point. Does that mean that the Fed is going to be less reluctant to do a steeper cutting cycle in order to offset slower growth?
Sure, and let's look back a year ago. A year ago, Q1, Q2, we had two consecutive negative quarters of GDP. And you remember a year ago, the big debate was, is that a recession? And most people said no. And what did the Fed do during that? They hiked, by 50 and then by 75. They were not deterred by a slowdown in GDP. So if we see the consensus forecast that at the end of the year we might see negative GDP numbers, if inflation stays elevated, I don't think that dissuades them from raising rates. What would is if we saw a big slowdown in the labor market. But as we all know, the payroll report has beaten 14 consecutive months. So we haven't even gotten a miss on the payroll report, let alone a slowdown on it. But if we did, that might be the game changer.
But how do you feel about the credit impacts that we've had? I mean, are we too complacent here that we've had this big credit shock? There's sort of the economy pre-March 8, then post-March 8. And it feels like there's one camp that says, well, we've just escaped that. It's just not going to have a big impact on credit and the labor markets. And then another camp that says, well, we've just not seen it yet. Where do you stand there?
Yeah, I agree with you that, March 8th was probably the most important economic date of the year, pre the bank failures, post the bank failures. And I do agree that we've seen a big credit shock, and we're going to continue to see that. Now, the credit shock's not going to probably result in another bank failure, but it is going to result in a pullback, especially for small and medium businesses. And I think that as we go forward, the Fed will look at that, but then Chair Powell's already kind of hinted that that's more of a regulatory measure. Michael Barr, the head of supervision at the Fed, it's his job to deal with that. Our job is to deal with inflation. So I don't think at the end of the day that the credit situation is going to dissuade the Fed other than push them from a regulatory standpoint, but not necessarily from a monetary policy standpoint.
Jim Bianco, thank you. Jim Bianco with us today from Chicago. Really interesting idea, folks. I think some people share this, but maybe it's not articulated, of disinflation, inflation down, and then he's calling for a tick up there. That's an outlier call right now, but it's tangible.
Yeah, really interesting to hear. Haven't heard much about, inflation is bottoming. And it sort of makes sense when you think about the Fed cycle that's expected, this stop and go sort of cycle. Sort of makes sense that you would also see inflation follow that path.
I mean, it's going to be interesting to see, and we're going to see it in the data today. And again, we will have ISM for you later this morning. That first look, I've never looked at it, but Pharaoh, he's like up at 2 a.m. getting ready for it.
Today's the day.
Today's the day. We're going to continue. Ellen Zentner of Morgan Stanley is with us. We'll have ample time with her in the back half of the next hour. Coming up, if you are in the equity markets, if you are confused, Anna Hahn, equity strategist at Wells Fargo. We're going to do that next. What a list today.
It's great.
I'm tearing up.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
These CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Fenway Sports Group has become a $10 billion global powerhouse. CFO Julie Swinehart tells Tom Keene how she's helping the company raise its game.
Winning's at the core of everything we do here, and the balance sheet is so important to the success of the team.
Watch Chief Future Officer Wednesday on Bloomberg.
Bloomberg Surveillance, and we say good morning. Catherine Geifeld with me this morning. Abramo out, Farah out. We are in. And yes, someone emailed in from Washington. Secretary Yellen, yes, Endicott will go to Ben's Chili Bowl on our recommendation there to boost the Washington economy this morning. For those of you that don't know, the best shop and food. I mean, all of Georgetown's got nothing. You got to go. I mean, it's like emotional. It's like really cool. And they have it at the airport, but it's not the same.
Oh, well.
The airport sort of just
doesn't count.
The romance didn't translate over from it. What translated is Katie and I thought this would be a sleepwalk today. No, it's actually really, really interesting. Curve inversion, 108 basis points. Katie, you mentioned 4.93%, up 3 basis points on the 2-year yield. You talked to Jim Bianco there, and you get this higher yield ferment there as we start the second half.
Yeah, and that curve inversion, I mean, continuing today, you do have 2-year yields marching higher, 10-year yield pretty much flat, and we do have some movement in the oil market as well, and we have some headlines on from Tesla, so there's plenty to talk about. We're doing good.
If you're in the equity market, I'm going to get right to it. Ellen Zentner with us with Morgan Stanley, their chief economist. We're thrilled she's with us. We'll do an ample period here with Ellen on the backside of this half hour, but right now, it's not only the equity conversation of the day, it's the equity kickoff conversation of the second half. Anna Hahn at Wells Fargo brings prodigious math and physics with her to the study of what we got. I'm going to go derivative on her so I can save myself. I recommended Sheldon Natenberg's classic options textbook to some intern the other day, all the Greek letters and all that. I look at gamma as the accelerative tendencies of any given index. In this case, let's take the Standard & Poor's 500. We came off the mat from a bear market October. Maybe it's a bull market. Can you identify, with all your math and physics, a second leg of a bull market?
Well, I'll put in a quick plug because I prefer the whole book over Natenberg, but I'll let you go on that one. With the acceleration in the market, I think what's important is what's really dragging up the market and how much more can that go. The technicals on the Uber cap-led rally here look to be losing steam at overbought levels, but you've seen that really the correlation within these 500 names of the S&P 500 have declined because of that separation of these handful of names versus the rest of the market, and that's kind of what's bringing equity volatility lower. That might be what also has been people concerned with low breadth. So until we see that breadth expand, I don't think you see this surge second half.
Do you reallocate or do you rebalance? You're not going to tell me I'm supposed to sell Apple or Nvidia, right?
Well, perhaps not sell, but maybe not be overweight those kind of areas. So with the tech market especially being tied with growth and the way that yields might be going higher before they come back lower, we would recommend being more neutral in the space and looking for other growth opportunities.
Do you agree with that we could have an option where rates go higher and the price in the Bloomberg Total Return Index could actually go down to new weakness? Is that part of, the mix of Mike Wilson's? The Morgan Stanley's different because they got 47 opinions But is the general statement there that you could have a higher yield regime at Morgan Stanley?
Yeah, I think, look, there's a lot of parsing the economy versus the markets here, right? And the economy is not the markets. And so you can have higher interest rates trying to slow the economy, but there are other factors driving different parts of the markets. I mean, I think is that what you're saying, Anna, that like, because you've got just a handful of names, right, that are propping up the market, whereas the economy looks, stronger, but there's this constant concern that, okay, rates are going to go higher, but we're going to go into recession. And so I think you end up getting those differences.
There's definitely can be that deviation. You bring up a great point. There can be the economic health, there can be the economic recession, but what about the earnings recession? And I think those two can have absolutely different timings. And that's what we're a little bit worried about here. It's what's been in people's minds. We might see a recession that might be mild, and yet the consumer continues to spend, as sure that you've seen, but that spending is slowing. So how much does that deceleration or the gamma in that spending really start to bleed into equity corporate earnings? And that's what we as strategists are really trying to decipher.
Well, even still, it feels like some of the worst case scenarios for earnings have been lifted in the last couple of weeks, especially, when it comes to profits. Was that premature?
I think it is a little premature. I think you see some companies and corporates doing quite well, but what's concerning is if you look on a sequential basis, overall for the S&P 500, you're seeing that top-line revenue figures are declining faster than where the consensus EPS or consensus revenue numbers would put it. Now, take into account, we're also seeing more margin compression than expected. What happens, what's remaining of that bottom line sequentially for growth? Now, that's not to say, again, that could be a little different from where multiples trade and where the market can trade. Perhaps the market is already looking to next year's earnings, but we do have to keep in mind that we need to still get there and we have another 6 months.
I also want to get your thoughts on equity volatility. You brought it up, and you look at the VIX right now, it's below 14. Equity vol has been declining, but does a VIX below 14 feel right at this moment?
Well, when you say feel right, I would say given what's happened with the actual bounds and what's leading the market, it's not. I think that's part of what it is, that index correlation that brings it down. But on the other hand, who thought with this post-pandemic regime we would see a 13 handle again so soon, particularly with still the fear of recession. So I'd say that I don't know if it feels right. I can't say I feel quite comfortable, but mechanically it seems to be the right value.
And now the part of the show, folks, where we go Nassim Taleb on Anahan. We do this to punish her. The essay of the first 6 months rather was Larry McDonald wrote a brilliant essay, went out on the Wall Street, it was viral and all that. And he starts with a massive lump of money in ETFs, index funds, the wall of 401k institutional money out there. And then he walks through on top of it X number of derivative strategies, almost like tranches of a buildup of notional value. Do you and the quants at Wells Fargo feel that we are going into a second half with notional derivative instability potentials, or is there integrity to the system?
Now, that's a great point when you bring up instability, because are people hedged right now? When vol is cheap, you would expect the hedges are cheap. But why buy this downside protection if we're only going one way upwards? Feels like you're tearing up money. So
well, it feels like 1987, but continue.
So in that kind of environment, it comes to maybe it is prudent to have some protection, but we're not calling for a major pullback here or a major downturn, but perhaps, again, that deceleration in this upward trend we've seen. So I think that if you want to put on those option strategies, maintain your upside exposure, but also take some off the top in terms of your stock positions and consider rotating that to the less explored parts of the market.
Is your study that rebalancing works? I mean, Harry Markowitz died, the Nobel laureate, 95 years old. He's the one that gave us diversification and rebal. I'm not a big fan of rebal. Sell your winners. Where are you on that?
Well, I think it depends on timing. And here, again, we're not saying get out of your winners completely, but take a little. It's been 6 months and you've already gotten 33% on some of these names in the QQQ ETF and your passive. You can't be too mad about that one, and it wouldn't be the worst thing to take some of that home or pocket it and put it into something of the less.
See, that she sounds like a trader. I mean, well, she was a trader.
Yeah.
Let's take that home.
Take some profits, lock in some of those gains. I want to go back to that essay that Tom brought up. I think you were having a conversation with Amy Wu Silverman a week or two ago about covered call strategies. Some of the most popular ETFs out there on the market right now are covered call strategies. They sell call options. And when you think about the stability of markets and this drag lower in volatility, do those sorts of strategies have any volatility masking effects?
It is possible. And you think about if the average investor is selling calls, then the broker, on the other hand, has to buy those calls and they need to delta hedge. So when they buy those calls, they need to sell the underlying to hedge those delta positions. So you have this kind of dynamic where some people are holding these calls on their own outright, other people are holding them hedged.
What we do here, folks, is when any wise-ass derivative strategist mentions delta hedges, we always turn to the economist to translate. She's going all derivatives and Greek letters on us. Would you save us with a question for Anaheim?
Okay, I'll save us. So it's been really difficult with the incoming data being strong, especially when you think about jobs, for anyone to believe that there's any other direction but up for equities. And so, we're looking for another big print on Friday. And so, it's just very difficult for investors to get past that, right? So is that what it's going to take? Just a really clear slowdown in jobs, a really clear increase in jobless claims, something in order to get people to start to think that maybe there could be, more nefarious outcome for the economy in the back half of the year?
I certainly think that an employment picture is probably the linchpin that we're all looking for, and that's why we're so focused on every single jobs or wages-related release. And so right now, we expect the consensus, we're in line with about 3.6 on the unemployment rate. If that holds, I think the market has some of that priced in already, but unless we see, like you mentioned, something really concerning, a big uptick in unemployment or some big deterioration in the wage picture, for us, it seems like somewhat sideways to steady going.
What's your SPX level?
We're still at 44.20 in terms of for a soft landing. Now we've breached through that.
So I can take the summer off? Is that what that means?
Well, they are sell in May, go away. Maybe it's the sell in June, go away. But we wouldn't say quite go away. I do think that you could see some further upside, but the question is how much more? And towards the end of the year, as we start realizing that consumer spending continues to deteriorate and that starts to take hold and that earnings picture kicks in, I think you see a little pullback.
Anaheim, thank you so much. With Wells Fargo on an interesting Monday I'm absolutely fascinated, Katie, about the idea of Q1, Q2. Go back and look at what people actually wrote the second and third week of December.
The second and third week of December. Also, the second and third week of March, if you think about it. There was a lot of bearish cases built on what we saw in March that haven't come through yet.
That's every economist's nightmare, is that people will go back and look at what we were writing
I've never
back
done that
when.
with you, Ellen. But very quickly here, Ellen, to me, it's just an extension of a pandemic. We underweight the medical disaster and the timeline off of that medical disaster.
Yeah, I think we did. I think we underestimated how long the tails of COVID stimulus would last. I think we underestimated just how long the pent-up demand for services would last, especially among the wealthy. Like, there's still a lot of tails out there supporting the economy, and we're just all wondering, does it just evolve into, a nice slowdown as that fades, or do we fall off a cliff at some point?
Ellen Zentner, fall off a cliff. Where are you, Bramo? Ellen Zentner with us with Morgan Stanley, and we'll continue. We're really going to dive into the American labor economy here with Ms. Zentner in our next section. And again, thank you so much with Wells Fargo today. The market's churning. It's a Monday. Markets close at 10:20 a.m., whatever it is. S&P futures now down 0.1%. And we say good morning on radio, on television, Bloomberg surveillance. Katie Greifeld in for Lisa Abramowitz and Tom Keene. We've got lots to talk about here forward. But to me, and Katie, let's sum up here the whole debate of through the hours this morning. And the answer is there's 6 opinions for every 5 discussions.
For every 5 discussions in the markets and in the economy. We're going to get, of course, another big piece to some of the answers when it comes to the economy on Friday, perhaps, when we do get that jobs report. Expected to fall, Tom. That's amazing. 3.6%, near some of the lowest levels in decades.
Before that, it's a really eventful week. I think we're off for the colonies tomorrow, but factory orders, durable goods. We start on the 6th with ADP, That's delayed. Let me figure that out. That's a Thursday statistic, I think. With claims. We get ADP with claims. On the 6th, we get the jolts in there too. So the Fed's going to have a lot of vision Monday next than they do right now.
It's hefty. And then we also get another CPI print before July. We know that this Fed is looking at every single data release. Every meeting is live, and thus we hang on every single print we get.
Are Bramo and Farrell back by the CPI print?
I hope so.
I don't know.
Yeah.
I
don't know.
And we're getting a lot of talk on this morning. I mean, people they never miss me. They miss Farrell. I don't know what that's about. Green on the screen. The Nasdaq up. EV. Rivian. They did something. Rivian did something big this morning. Tesla did something big as well. We're all going to go over 4th of July and buy an EV for 2025 delivery. Coming up, Ellen Zentner of Morgan Stanley on Friday's jobs report. This is Bloomberg's Surveillance.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
U.S. growth last year was about, economic growth was 1% or so. It's tracking a little higher today, but we think it'll be slower than that for this year. We're in a growth, the U.S. is in a growth recession today. Growth recession is something above zero, but below growth potential. The U.S. has a potential to grow each year about 1.8%. That's a combination of productivity, 1.5%, plus changes in labor force, about 0.3%. The U.S. is growing below that.
Tony Crescenzi of PIMCO. This is what we try to do, which is bring a zeitgeist to you, directly to you. He is the short-term bond expert with Jerome Schneider at PIMCO. And, of course, off Dan Isaacson's PIMCO interview in the FT this weekend, which made global headlines. And PIMCO a little bit cautious there on what we're going to see in terms of price up, yield down, duration coming in there. Really informed conversation. Katie, I'm going to say, just to get it out of the way before we get to the show close, the team did just a tour de force job on a Monday.
Yeah, no, the guest lineup has been fantastic. I've been spoiled, because I'm a guest here. Had some great conversations.
Yeah, James from Australia emails in, thank you so much for having Ellen, and it's nice to see her working from office today. James, thanks for watching this morning. With us, Ellen Zentner of James Gorman's Morgan Stanley with us right now. I saw a hockey stick chart on manufacturing in America. Doesn't matter what the details are. The answer is it's something we're not used to. I have a chart that went back. I got a big splash with it 1 million years ago of manufacturing labor to our population in America. And basically the back was broken in 1970 and then really broken in 2000. Can we have a manufacturing renaissance in America?
Well, we can have increasing share of manufacturing in the economy. But these things are slow-moving beasts, and the decline of manufacturing over time has taken decades to play out, with larger step downs, as you said, in the 70s, and then as after the WTO and China's rise, right, more pronounced after that. And so I think we've got something exciting going on right now. I think we're digging into the data, and we're seeing that, and especially if you go around the country and you talk to small manufacturers in the country, which I have done, and they'll tell you that they're starting to get more and more domestic orders of people that are onshoring, and they're feeling the effect of it. They believe we're having a
manufacturing renaissance.
They at least feel that their business is picking up. Now, this feels like it could be the start of something. We're seeing something. There is some onshoring story there. There's some nearshoring story there. I think the story around Mexico's benefit from nearshoring is exciting. There is a lot of infrastructure building going on across the country. State and local governments have been ramping up hiring around that as well. So I think there's something going on in manufacturing here that is exciting, but that's a smaller share of the economy than the services side.
And Katie, one of the unspokens here through June is Mexican peso stunning in its Mexican peso strength through 20, through 19, through 18. You're going to get a 16 handle on Mexican peso at some point, which is, I never thought I'd see that.
Yeah, and it's, important to remember because we talk about how strong and resilient the dollar has been all the time, but there's definitely some pairs where that is not quite true. But Ellen, of course, we have you on Monday. We get the jobs report on Friday. Is there anything that we could get at 8:30 a.m. on Friday that would take the Fed off the course for a 25 basis hike later this month?
Yeah, so we've given this a lot of thought. So we have these roadmaps to each Fed decision that we produce of here's what we think the data will look like in hand, and this is what we think their response will be. And because it seems like, yes, they're data dependent, but it feels like they're sort of locked in for this July hike. I think the bar is just a lot lower than we thought it would be, that you would have to, for the data to say don't hike. And so I think it would be a payroll print less than 100,000.
Right. Wow.
Because really, that would get the market thinking maybe they're not going to hike in July and then still wait for that CPI print to do the rest of the job report. And if you got a downside surprise in CPI as well, then I think that would be the final box to tick off that says, okay, it doesn't have to be a July hike.
Right.
I think it would still keep the Fed saying, hey, there's still maybe more to do. I think there's still going to be an asymmetric hiking bias. But I think it would have to be some pretty big downward misses for them to not hike in July.
Yeah, definitely. And important point that we do have CPI before we do get to that July decision. But when you look at, and I don't want to get too short term here, but when you look at sort of the expectations that are baked in for the Fed to go ahead in July for, probably the labor strength that we've been seeing to continue with June's report, what do you think would prompt the bigger reaction in markets? Is it an upside surprise or a downside surprise?
I think it would be a downside surprise because the market is the Fed's been really successful here. The market is saying, okay, they're on this hiking bias, and we're going to give them the benefit of the doubt that it could be 2 additional hikes from here, not just 1 additional hike or no hikes, or even pushing out the expectation they could be cutting before the end of the year. I think the market has really grabbed onto that narrative, and the data has helped support that. So I think it would be a downside surprise that would probably get the bigger reaction.
Are we partitioned where part of the American public has a 2% unemployment rate and another part of the public has a 7% unemployment rate?
Yeah.
How does Morgan Stanley see the quintile makeup or decile makeup?
Well, look, it's more around, sort of education level. But
the poor, the bottom decile's done well off the pandemic, right?
They have, from government support, which has now ended. Okay. They have off of a tight labor market, which has increased labor income and wage growth, especially for low wage paying service sectors. But we're only just now seeing real wage gains positive. So it was really, inflation was still outpacing wage gains for those folks. But that divergence between sort of those with a 7% unemployment rate and those with a 2%, it's really, you go all the way to like a 13% unemployment rate and those with a 2%. That has always been the case. It's always been the case. So what I look at is, has the unemployment rate been improving across all by ethnicity, by age, by geographic location? Like, has it been improving across all groups? Yes, it has. And we are back to the kind of tight labor market for the most underserved in the country being just as good or as tight as it was pre-pandemic.
Yeah, I look at this, and Alan, you know, they said to me, can we get Zentner for the Monday before 4th of July? And I said, well, she's probably going to be in waders and some trout stream and Chile as well. But, you know, folks, this is really a sacrifice on the part of Ellen Zentner, because she's going to take a nymph and a fly rod that I can't afford and go out in the river. This is the Zentner you don't know. Fly fishing with Zentner. Did you do the saltwater thing, the Seychelles and the Bahamas?
Not as big on saltwater fly fishing. I do like saltwater, but not to fly fish.
You know, you go to Jackson Hole.
Can't cast far enough.
Yeah, you go to Jackson Hole, the Smith River, Salmon River, Jellystone River, and all of it. But Patagonia, we had listeners today emailing in from Chile with your appearance here today. And there's like the Rio Simpson, like Chile's like huge trout fishing. And the fish are ginormous, right?
They're ginormous, yeah.
Why are they so much bigger down there?
You know, they don't get a lot of pressure. There's not a whole lot of people going down to Chile. It takes quite some time to get down there to fish. And do you know? Probably. Well, there's one I can't say publicly because then everybody will go.
Oh, here we go. See, this is when you live large at Morgan Stanley.
Gatekeeper.
Let's say like the Beaverhead in Montana, because everybody knows that one, and it is a great river. But I won't say the one that's my absolute favorite, because then it will get more pressure.
Could you get the makeup when next time was that? Can we get a beeper in here so we can see that someday in Montana? Is the fishing good near Jackson Hole, Wyoming, the third or fourth week of August?
You know, well, it depends, right? The runoff was really big this year. A lot of those record snows, right? The river levels are high, and it's not been high like that in quite some time. August has been really dry. But if you love cutthroat fishing, then you want to be around Jackson Hole.
James Gorman thinks she's cutthroat. She's going to be on the phone the first week of August. I just really think I need to go to Jackson Hole to read academic papers. This has been a joy. Ellen Zentner with us here on radio and television. Katie Greifeld, I'm going to tear up here. I'm going to miss you.
This was great.
Thank you. It was wonderful.
I had a lot of fun.
I wonder if I still have a job Wednesday. Good morning.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power. Every weekday at 5 p.m. Eastern. Only on Bloomberg. your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg. From New York City, for our viewers worldwide, happy July 4th Eve. I'm Caroline Hyde, in for Jonathan Ferro. The countdown, open starts now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Coming up, Q3 underway with Friday's jobs report. It's in focus. Russia and Saudi Arabia extending production cuts another month. That's as Secretary Yellen heads to Beijing in hopes of easing China tensions. But we begin with the big issue, the kickoff of the second half.
Going into the second half of the year.
The second half of the year.
Be careful what you wish for.
It's the labor market and consumer spending that are the things I think you need to pay most close attention to.
Data.
The economy is pretty robust.
Things are continuing to be much, much better than expected.
Markets now need to contemplate what the future holds.
I think it's hard to be really positive looking forward.
We're going to have weaker growth.
Weakening in the second half. We are slowing. There's no doubt about that.
We're expecting margin compression.
We're actually starting to creep back towards overbought territory.
There's room for a pullback.
We're very cautious. Whatever this is, whether it's a recession or a growth scare, I do think it's starting.
Let's dig in, because today we do see a bit of a mute market, but still the Nasdaq 100 drives higher after a phenomenal first half. BNP Sam Linden-Brown joins us, Invesco's Christina Hooper. And Christina, I want to start with you there. Welcome to the show this morning. And I'm interested in what's happening in terms of whether the second half can in any way sustain the fuel that we saw in big tech in the first half.
Well, Caroline, what I think we're going to see is a period in which markets sit in a trading range, and perhaps we see a small pullback in the next several months. Clearly, there has been a lot of excitement in the first half of the year, and there needs to be time for that to be digested. Having said that, though, I think by the end of the year, we'll see that the S&P 500 has finished higher.
Okay, interesting. Just to dwell on that, finished higher from where it is now, finished higher just all on out on the thriving first half of the year?
From where it is now, but modestly. Okay. What we're experiencing right now is a period of uncertainty. We've gotten so much hawkish Fed speak, although I think it's largely bluster. What the Fed needs to do, though, is keep a lid on financial conditions really easing. And so it's important that we hear that very aggressive Fed speak. It should cause some kind of pullback in markets, and that's what we need to see right now. But I think by the end of the year, it will become clear that there will be an economic recovery in the offing in 2024, and we'll see some movement upward in stocks.
How global is that, Sam? Because I'm looking at the Eurostoxx 50 on track, if we hold this level above 4,400, to be the highest since December 2007.
We'd have sympathy with the view that Christina put forward of an economic rebound in 2024, but we'd be a little bit more cautious on the path that we'll need to first get us there. And the key point on our side here is, in order for central banks to stop hiking, we think they need to see more evidence in the persistence of the inflation trend turning south from the very strong levels that we've been getting recently. in order for that to happen, we think the market needs to price in more of an earnings recession, because without wage growth decelerating, which will only happen if the unemployment rate rises, which will only happen if companies lay off workers because they're less confident about the forward-looking outlook, then we're not too convinced that inflation is going to fall to a level that's acceptable for central banks to stop, as Christina said, this recent hawkish rhetoric.
Let's just go cross-asset for a moment, Sam, and dig into some caution we've heard around the debt markets, in particular corporate debt as well. I heard some of those alarm bells being rung. It was in the FT, I think it was, the CIO of PIMCO, Dan Iverson, obviously a friend of this show for John Ferro. He was saying, look, they're preparing for a harder landing. They are worried about parts of the debt market, particularly leveraged parts. Do you think that this is a buying opportunity in bonds as well as stocks, or no?
In bonds, I think the cyclical case to own duration in the US is compelling. The problem is, if we continue to see this economic resilience, that's really telling the market that neutral rates, R* is higher than was widely perceived. And if that's the case, it means that we could be due for an upward adjustment in longer term maturities, rather than what we've been seeing more recently, where when the curve flattens, it's bear flattening, with more tightening getting priced into the front end, but with that not permeating to longer maturities. Our view going forward is that what we might actually see is the market starts to price economic resilience more in longer maturities. It's a dynamic which would imply it doesn't just mean the Fed have more work to do, R*'s higher. It's a dynamic which would imply that some of the inflation risks, which for the past decade were priced to be asymmetrically lower, are now actually asymmetrically higher. It's a dynamic which we have a lot of sympathy for at BNP.
And sympathy for also, going back to the equity markets, Christina, an alarm when it comes to a need for breadth in this market. It was interesting that JP Morgan in particular sounding the alarm on the equity rally today, really writing that the consensus view that the worst of the pressures is behind us will be proven wrong, as the impact of monetary tightening has historically worked with a lag and certain growth supports are waning. Unless there is continued broadening in leadership, the overall index could struggle to advance in further second half. You were just saying how you anticipate, Christina, the second half to see some sort of growth in the S&P 500. Where is the breadth going to come from? Which sectors, which industry groups can start to outperform other than a few names in the NASDAQ?
So I think the breadth comes from the end of the recognized end of tightening and the expectation that an economic recovery will come. So we'll see cyclicals perform better. We'll see smaller caps perform better as markets anticipate that recovery. That tends to be the segment of the market cycle when we do see more breadth. This is rather normal to see this kind of a narrow breadth in this part of the market cycle as we anticipate the slowdown.
Let's just talk about anticipation of a slowdown and really investors tempering their expectations after what has been just a phenomenal first half of the year. As I've been mentioning, the NASDAQ 100 closing out its best first half on record. Let's look back, let's look forward. None other than Bloomberg's Katie Greifeld doing double time today.
And just to look back briefly, remember back in the start of 2023, really strategists were anticipating a flat S&P 500. That's not what we've gotten so far this year. The S&P 500 rallying about 16% year to date in the first half. Then you take the cross asset look. You've actually had crude come down pretty sharply, down 11%. Copper off as well. Not as much as you would think when you think about what we've seen since the end of January. Overall for the year, though, only off about 0.5%. And you also have the Bloomberg dollar down about 1%. Not exactly the wither the dollar expectation that we had, again, coming into 2023. But now that we've had this really strong first half in the equity market, the question, of course, is where do we go from here? There's been a lot of calls to the downside that basically we're going to see some of that strength be given back. But if you look at the historical data, when you look at double-digit gains in the first half, typically it leads to strength in the second half. The most recent example we have is from 2021. Of course, the double-digit rally that we saw in the first half of that year was met with an 11% rally in the second half. Whether this happens again, whether history repeats itself, we'll see. But I do want to talk about the bond market. I find this chart absolutely amazing. You're looking at the 10-year Treasury yield It entered the year at 387. It's at about 383, 384 or so right now. So almost flat for this year, Caroline, though, with a 75 basis point range.
Really, Katie, always going cross-asset for us. We thank you. And let's stick with going cross-asset. Let's just pivot back a little bit to what Deutsche Bank was saying. George Saravalos, who's been expecting the consumer in particular to play a key role here, writing, quote, look, the pretty uninspiring consumption picture points to imbalances within the economy and restricted supply driving inflation, actually, rather than excess demand. The second half, he says, will be all about whether the market is right to expect inflation to come down as these imbalances get resolved while the consumer stays, quote, boring. Sam Linton-Brown still with us, Christina Hooper. Sam, how much is the consumer going to be boring in your mind's eye?
I think the consumer's clearly absolutely key here. And I think the key point I'd make is if the market and the equity and credit market in particular is right about the outlook for growth that it prices in, strength in the consumer, especially the US consumer that it prices in, then our view at BNP Paribas is the inflation rates won't fall down to a level acceptable for central banks to stop hiking. And so I'd argue you have this discrepancy between front-end nominal rates, the inflation market, and the equity market. If the equity market's right on growth, that implies no recession. That implies inflation will stay too high, and that means central banks will have even more work to do.
But is the market right, Christina, from your perspective, or is the market well ahead of itself?
Well, certainly the market has gone ahead of itself, but it's moving in the right direction in terms of expectations. I think we're not going to see a hard landing. We're going to see a bumpy landing, which means that it is not going to be easy. There will be economic damage, and certainly we'll see some pressure on the consumer. But I think the key metric that we haven't looked at or we haven't talked about today is consumer inflation expectations. We got two very important readings last week, Michigan consumer inflation expectations, and then also we got a euro area inflation expectations. And what that tells us is that inflation expectations, especially for the one-year period, but also for the longer term, have come down very significantly. And that is so important because that helps consumers, that helps tell us that consumers are going to sit on their hands and wait for better prices to buy things. If we look at 1980, inflation expectations were at about 10% for the one-year ahead period. Of course, that created a self-fulfilling prophecy where consumers continued to buy because they expected prices to go up so much. We're in a very different position today with inflation expectations at around 3%. Over the longer term. That means that consumers are going to sit on their hands, and of course they're also under pressure. So this is an environment where inflation is going to come down. Yes, core has been stubborn, but core tends to follow headline, and headline has come down a lot.
Sam, to that end, consumers sitting on their hands, are they therefore saving? What's been interesting is that they haven't as yet. And Bridgewater's co-CIO, Greg Jensen, was actually on the Odd Lots podcast recently, focusing on the impact of higher borrowing costs, saying that in his view, you will end up with growth disappointing a bit and inflation disappointing on the high side. And they're saying it's probably going to be bad for bonds and equities and generally weaker growth. And if that weak growth starts to translate into rising savings rate, you can easily end up going into a recession. Any part of BNP have sympathy with the recession call?
I think first off, I'd very much echo the points that Christina was making around the lack of parallels when it comes to inflation expectations with what we saw in the 70s and 80s. Very much on the same page here at BNP Paribas with that view. I think in terms of the outlook for the US consumer in the context of savings, what we've seen is that savings were super high because of COVID. Those savings have now been run down materially. So when we look at excess savings in the US, they reached a level in 2021 near to 2.4 trillion. And that level has now been run down to, on our estimates, closer to $700 billion. So there's still a buffer, which means that the lagged impact of monetary policy may continue to be slower than some expect to slow down activity in the US, but that buffer has certainly alleviated to a large degree. I think another key element here for the market outlook, above and beyond the economic fundamentals in terms of what's going to drive prices, is the shift that we're going to get in liquidity dynamics in the second half of the year.
Said. Sam Linton-Brown sticking with us, Christina Hooper as well, joining us to just have a little look on what's happening right here, right now on the movers of the day ahead of the opening bell. Abigail Doolittle, take it away on some of the movers.
Well, Caroline, we may have the futures basically flat here in the pre-market, but one space is really popping higher. That, of course, is the electric vehicle space. Tesla leading the way. Well, actually, Rivian now is, but Tesla up 5.5%. Record deliveries. They delivered more than 466,000 cars worldwide on those pricing cuts. But JP Morgan is saying that some of this stabilization may suggest that we also have demand stabilizing as well. Nikola going along for the ride, but Rivian up 8.4%. They also put up big numbers relative to the company. They delivered nearly 14,000 vehicles. The expectation was closer to 12,500, and they're saying that they're on pace, Caroline, for 50,000 annual production, that guidance. And I will note, I did actually see within the span of about 5 minutes on Saturday, 2 different Rivian vehicles.
Rivian spotting in the wild. Abigail Doolittle, we thank you. Meanwhile, coming up, look, interesting that some of that pickup in EVs was happening in China, even as China's weaker than expected recovery.
The reality is that people have given up on the Chinese recovery. The major problem here is that, China's moving off its old economic growth model, but it hasn't moved comfortably into what's next.
Manufacturing activity slowing in China. That's as Secretary Yellen prepares to visit Beijing. That conversation up next. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great
evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
The major problem here is that, China's moving off its old economic growth model, but it hasn't moved comfortably into what's next. You're seeing much slower growth overall. You're going to see a long-term structural slowdown in the Chinese economy, and that they haven't truly prepared the world for that or their people for that.
And that data bore out overnight. China's manufacturing activity just slowing in June, adding to that evidence that its overall recovery is cooling. Meanwhile, of course, Treasury Secretary Janet Yellen is heading to Beijing this week in an effort, of course, to keep on mending that US-China relationship. Bloomberg's Enda Curran joins us now, and we'd anticipated some sort of meeting. Interesting, there's been a changing of the guard of who indeed she's going to be meeting with.
Yeah, this meeting has been a long time coming, Caroline. The basic premise of it is that the Treasury are managing expectations. It's all about improving communications between the US and China, perhaps looking for areas where there can be some cooperation, but that's expected to be modest. But there's certainly no indication that there's going to be any kind of a substantive breakthrough in the issues. Remember, Treasury Secretary Janet Yellen's purview is the economy. She can't really stray into terrain like national security or trade or other areas. She'll probably be meeting mostly with the economic officials, Caroline. Unlike Secretary of State Blinken's visit a few weeks ago, it would be less likely she would be going up to meet the top of the government, which of course is President Xi Jinping. So I think the expectations in this one, as I say, they're being managed. The focus will be on the economy and probably several meetings with economic officials in and around her rank.
Enda Curran, thank you for bringing us that. We'll anticipate that after the joyeties of July 4th celebrations here. Meanwhile, Sam Linton-Brown and Christina Hooper are back with us. And just, Sam, bring us your global perspective here. China, how much of it is a weight on global growth? How much are you concerned by the fact that the economy hasn't expanded or picked back after COVID as many had anticipated?
At this level, I think a lot of the pessimism on the growth backdrop in China is now quite well reflected in the price, and probably what we're actually likely to see is that the next big repricing in the market, we think, will be from very pessimistic growth expectations to slightly less pessimistic growth expectations. The catalyst for that change, we think, will come from a policy easing package that will be announced towards the end of this month and the beginning of August at the next Politburo meeting, and we think that will reprice market expectations slightly more on the positive side for China from what we'd argue now is really quite pessimistic.
Christina, that's the PBOC at play. What about the limits from a geopolitical perspective? We're just seeing overnight news that, look, China wants to be limiting metals used within chips. Of course, this is this tit for tat, the trade, the tech war that's going on. How much is that a limitation as well on global growth?
Well, it certainly can be modestly problematic as well as, mildly contributory to inflationary pressures. But I couldn't agree more with Sam that the view on China is very, very pessimistic. It's priced in, and I don't think it deserves to be that pessimistic. Certainly over the weekend, a monetary policy report came out that suggested there's a need for more monetary easing. I think we're going to see that. I think we're going to see some fiscal stimulus coming from China. And we have to recognize that the manufacturing PMI readings reflect global demand. And as we know, central banks are slowing global demand by design. So that shouldn't be a reflection on real problems within China. I think it's much more accurate to look at services PMI. That's remains still quite robust. Again, China has an economy not dissimilar to other economies after they reopened, where we saw things very lopsided in that manufacturing was weak and services was strong.
I like that you bring in manufacturing because we're about to get a manufacturing reader here in the US, of course, ISM a little bit later, the S&P reading just in, 25 minutes. Sam, European manufacturing has been slowing. We've seen that sub 50. We've also, of course, had China's manufacturing coming in a little bit weaker than anticipated overnight. How much is the China slowdown a European story as well?
I think there's certainly a good case to be made that the linkages between the two economies have contributed in sort of a circular way to the concurrent downside misses we've had out of both the Eurozone and China. I think the slowdown we're seeing in manufacturing, though, as we heard last week in Sintra from President Lagarde, is yet to feed through to a sufficient extent to services such that it's going to alleviate enough of the inflationary pressure in Europe that it really has a big impact on the outlook for ECB policy. So we think that despite the weakness that we've had in European manufacturing, the ECB will continue to hike rates. Our central case is 2 25 basis point moves from here, so taking the policy rate to 4%.
Okay, at that level, we've been talking, Christina, a lot about the 4% level here for US Treasuries, for example, that becomes the buying opportunity. When we're thinking about rates still potentially being hiked as soon as July, but then a pause there, is that your perspective for US central bank policy as it stands?
I still think there's a very good chance we don't see any more rate hikes from here. We could certainly see one more, but that is not my base case right now. Just given, again, looking at the mosaic of data, including inflation expectations. So, but if we do see 1 or 2 hikes, this still represents an attractive buying opportunity for fixed income, especially investment-grade credit. Longer duration, at least a portion of one's portfolio being longer duration. Historically, this has been a good time to buy.
It's been wonderful having a good time with you both this morning. Thank you so much for the perspectives across asset today. Sam Brown giving us the global perspective, Christina Hooper for dishing out on credit there. We thank you both so much. Meanwhile, coming up, the morning calls. And later, well, Tabakan's Michael Purvis joins us around the opening bell and his outlook for the second half. From New York, this is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Countdown to the Open. I'm Caroline Hyde. Let's take a quick look at these markets because, well, after a run-up like none had expected in the first half of the year, we're taking a breath as we head into the second. Volume's thin. We've got S&P 500 just up about 0.1% in the futures market, but NASDAQ 100 futures up again after what is a record start to the first half of the year. Time now for some morning calls, some of the analyst recommendations this morning. First up, Goldman Sachs actually adding Southern Company to its conviction list, saying it's uniquely positioned to provide stronger clean energy growth. Next up, Wolf Research upgrading Lazard to peer perform, seeing an attractive valuation with a clear path to better margins. And finally, Canaccord raising its Tesla price target to $293. Look, it's expecting the automaker to continue gaining market share after those record Q2 deliveries. Meanwhile, coming up, look, Tesla providing an early boost for big tech. We saw the NASDAQ 100 futures there. It's logging its best first half on record. That conversation up next with Talbacken's Michael Purvis. You want to stay tuned. Thin liquidity ahead of a July 4th celebration. From July 4th Eve, this is Bloomberg.
Connection lost.
Crucially important, and I think we've moved from
this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. The best question I get all night.
Bloomberg, top experts, great questions.
This is Countdown to the Open. I'm Caroline Hyde, in for Jonathan Ferro. He is missing. Well, it looks like the nice season fun going on. People in fancy dress ahead of July 4th celebrations. A day ahead of that, volume's going to be muted. We are seeing the S&P 500 futures just off by about 0.1%, but the Nasdaq 100, the celebrations coming the VEX indices today, managing to push on higher after a phenomenal record first half of the year. Let's go across asset a little bit, though, as well, because Europe, we are seeing strength in European stocks today, at least on the Euro Stoxx 50, managing to potentially close at the highest since December 2007. A little bit of weakness across the DAX, but we're looking at euro dollar just flat on the day, 1.09 as the dollar stays weaker, well, relatively flat on the day too. 10-year yield getting a little bit of a bid there, 2 basis points on the downside in terms of yields, 3.81. And New York crude only up 0.3% now after that news coming out of Saudi and Russia. We'll dig into it in a moment. But one stock to watch, of course, at this open, Tesla helping that Nasdaq 100. Shares jumping after reporting record Q2 deliveries. Ben Callow writing, quote, "It's a big beat. People were still bracing for another round of price cuts, but these numbers make that less of a risk." Joining us now, my friend, my co-host of Bloomberg Technology, Ed Ludlow, on the case. And, I mean, it was a big beat, but not only, it seems, for Tesla in terms of EVs.
Yeah, a lot going on. Numbers flying around the world from all kinds of EV makers. Tesla delivered 466,140 units in the quarter gone. That was a big beat relative to the Bloomberg analyst average estimate of 448,350, up 83% year on year, that delivery beat, which is interesting. It shows that they continue to grow at a phenomenal rate. What's interesting is it's still a case of Tesla producing more vehicles than it's delivering, but Ben Callow, among the analysts, noting that the gap is actually shrinking, and less concern in the market now about further price cuts. But we also got numbers from BYD. BYD almost doubled its deliveries of battery electric vehicles to 352,000. You were noting in that LinkedIn post earlier, right, Caro, that you throw plug-in hybrids to the mix, and BYD delivering more than 700,000 vehicles in the quarter gone. Ooh. It's the biggest brand name going when it comes to China. And remember, in that market, many more players, many more models. Tesla faces much stiffer competition there, though it's the clear market incumbent here in the United States. Real quick mention of Rivian. Those dropped this morning as well. Production number 13,992, delivering 12,640. Real ramp up from their own production numbers in the first quarter. They've shifted a key component in-house, the Enduro motor. They were using an off-the-shelf product from Robert Bosch. That seems to have helped them address some of the supply chain bottleneck that they had, and that stock, well, up almost 9% in early trading.
6:32 a.m. in San Francisco. Ed, how close are you to your 6,000 tweet limit as a Blue Twitter subscriber
Yeah,
today?
really interesting. Well, that didn't last very long, did it? I think we're up to 10,000 now. But, you know, again, it's another example of Elon Musk just making a policy decision on the platform. How long does it take to view 10,000 tweets? As you know, you and I both spent a lot of time on that platform. But over the course of the day, they kept edging it higher.
Yeah.
A lot of criticism and chat about that on the platform as well.
If I believe in anyone who can get to 10,000, it's you, Ed Ludlow. Thank you. Meanwhile, sticking with tech, Apple slashing production targets for its Vision Pro, according to the Financial Times. The FT writing, quote, Apple has been forced to make drastic cuts to production forecasts for the mixed reality Vision Pro headset, hailed as its most significant product launch since the iPhone. Bloomberg's Abigail Doolittle is all across this one, and it is a big cut, it feels like.
It does feel like it's a big cut. On the other hand, this is not clearly their main driver from a revenue standpoint, so the stock down mildly. That said, the stock breaking a 4-day winning streak, the longest winning streak in more than a month. And of course, one, Caroline, that took the stock above that $3 trillion market cap level that everybody was watching. It is still above that level. Relative to the cuts, they are now preparing to make fewer than 400,000 units of the almost $3,500 headset in 2024. As you mentioned, this is a report out of the FT, and there's some suppliers that are saying that they're only ordering enough parts for 130,000 to 150,000 units. So if that's the case, that's a pretty significant cut. But again, this is not their clear revenue driver, and if it should be at some point in the future, that would be a far way out. My question is whether, you know, how many people are actually willing to spend that much money on this product. I guess time will tell on that one, Caroline. But, you know, as you know, it all comes down to the iPhone. The stock right now down about 0.3%.
Interesting supply chain limitations there, Abby. We thank you. Meanwhile, over to financials. Big banks, including JP Morgan, Goldman, they're announcing higher dividends after every lender subject to this year's stress test passed. In fact, JP Morgan CEO Jamie Dimon saying, quote, we remain prepared for a broad range of potential outcomes, including potentially higher future capital requirements from the finalization of the Basel III capital rules. Joining us now, Bloomberg's Katie Greifeld. And, well, it seems across the board, resiliency is the word of choice.
And you are seeing the banks lift a little bit this morning, even though this is typically how it goes. Of course, the big banks, they pass the annual stress tests and then they boost their dividends. We got that this year as well. The 5 biggest banks out with their new quarterly dividends at the close of trading on Friday. Goldman Sachs, the new number is $2.75. That's an increase of 25 cents. That's the biggest boost among the big 5. You also have JP Morgan now. That quarterly dividend clocks in at $1.05, up from $1. And even Citigroup went through with a bump of about 2 cents, even though that bank in particular faces higher capital requirements because of its test results. But looking ahead, though, now that we got the dividend increases, we might not get that paired with higher share buybacks. As you mentioned, of course, the big banks are under a lot of regulatory scrutiny right now, and that could limit those commitments that we get later on, Caroline.
I mean, Silicon Valley Bank feels so long ago now, but what an impact it had across the entire sector. Katie, thank you so much. Meanwhile, we're going from the big banks back to the big tech story. Talbacken's Michael Purves writing, cracks are spilling into the NASDAQ 100. What we see developing here is the continuation of a risk-on sentiment, but this risk-on is increasingly obvious through rotation into value and cyclicals. I'm pleased to say Michael Purves joins us now. So NASDAQ 100, the run-up, it's over, do you think?
Well, you never know with a rally that has been so strong, so compelling, and with a fair amount of FOMO driving it. Bottle rockets can, shoot pretty far before they do roll over. But I think, if you just look at some of the momentum indicators on the NASDAQ, you're starting to see them in a very different place than you have earlier this year. And one thing, if you step back, NVIDIA, the 3rd largest position in the NASDAQ, 4th largest in the S&P 500, the technicals on that stock in particular look really cuspy right now. Look like they're really rolling over. So I'm not, it may be a stretch to say if NVIDIA rolls over, the rest of its peers, Apple and Microsoft and so forth, have to roll over as well.
Yeah.
But it's something I'm watching very closely right now.
And how were you playing that, Michael? Because I know you were looking at options when it came to NVIDIA.
Right. Well, I'm not quite there yet. It's a pretty aggressive call to go out with saying buy puts on this the stock that is just absolutely soared and has a lot of FOMO going into it. But I will say this, I'm getting closer every day to actually going out and pulling the trigger on that idea.
Wow.
There. So I think it's probably in some ways a more obvious play than the NASDAQ, which of course is, is a basket of stocks and there are some, reasonably good stories here. But I think, look, you step back, you're looking at a NASDAQ that's had an enormous PE expansion. Here, we're up to 26.5 times, which is about as high as we got during the heady days of late 2021. And this PE expansion has happened during a period where interest rates keep, across the curve or keep edging ever higher here, right? So, you're dealing with a NASDAQ equity risk premium that's actually negative right now.
Yeah.
So I think at some point, you are going to start seeing that stuff roll over. And I think we're getting close to that point.
Is that point, Michael, is that point earnings? Because we were hearing, for example, from JP Morgan, seeing earnings risks as after what has been an amazing first half, and the strategists there writing that we were bullish on earnings for the past 2 years. While the second quarter could still be resilient, we do not expect upgrades for the rest of the year. What about downgrades? What about the unsettling notion that earnings are going to fade this?
Yeah, well, certainly at the index level, let's just talk S&P 500 for a moment. There, I think there's a strong case to be made that earnings will be okay, but they won't be great, right? And so how much do you really want to pay for, mid-single digits earnings growth into 2024 when nominal GDP, which helped inflate earnings last year, earnings were up 10% last year, a big surprise for most people, right? But that was a lot of inflation, and that as that inflation comes out, and it's coming out, for the broader index, you will start seeing, I think, sort of like a return to, sort of mid-single digit earnings growth as we get to 2024. Do you really want to pay 19.5 or 20 times in the S&P 500 for that earnings stream? I think that's a real big question. As it relates to things like NVIDIA, I think there's a big question as we get into the second quarter season, which is now just, starts a couple of weeks from now, where the earnings are, I think like earnings estimates for NVIDIA basically doubled in the last quarter. Can they keep that excitement and that upward trajectory going higher, or do they kind of steal the thunder for this quarter or the next quarter there? I suspect that's the case there. So I think that's going to be another case where people are going to be like, look, I have my fill of NVIDIA. I'm paying 25 times revenues for a stock that's massive. It's a very scaled company, right? There. And so I think valuation does matter.
In 30 seconds, you talk about the rotation. One area to rotate into at the moment?
Well, look, I mean, industrials have been pretty good. I think they're going to stay pretty good with the whole relocalization theme. I think that is a place where you're going to see earnings doing pretty well. If you look more broadly at the S&P equal weighted index, which is effectively a value proxy, there you're looking at a case where the PEs there are actually really pretty reasonable there. They're actually lower than they were last August here. So I think that at the index level, like the S&P equal weight, I think is a pretty safe place to put your money there.
Yeah.
Within more specific sectors and so forth, industrials, and believe it or not, yes, banks too.
Michael Purvis sticking with us, pleased to say. We can go more fundamentals in a moment, but coming up, more oil supply cuts in the pipeline.
The cuts of the OPEC Plus actually started back in November, where we still didn't have information how demand is going to be panning out. You can actually say that OPEC Plus has been fairly proactive and very, and had a very quick reaction in 2023 when the global demand numbers didn't pan out.
More on oil next. That conversation coming. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Fenway Sports Group has become a $10 billion global powerhouse.
CFO Julie Swinehart tells Tom Keene how she's helping the company raise its game.
Winning's at the core of everything we do here, and the balance sheet is so important to the success of the team.
Watch Chief Future Officer Wednesday on Bloomberg.
Global economic pain may turn into emerging markets gain. Investors say they plan to allocate more funds to emerging markets over the next year. That's according to the latest Bloomberg survey of professional and retail investors. More than 60% of respondents are betting emerging markets will either push higher or outperform the developed markets if the U.S. economy tips into recession. This would mark a significant change in leadership that's been in place for more than a decade, in which U.S. stocks have returned more than 700% since March 2009, dominating the rest of the world. Within EM, market watchers rank stocks as the best investment, followed by a tie between debt in local currencies and U.S. dollars. Lower valuations is a big draw. In equities, the MSCI Emerging Market Index trades at 12.5 times estimated 2023 earnings. By contrast, the S&P 500 has a multiple of more than 18.5. External factors may end up proving to be bigger influences on emerging markets than domestic politics. The dollar's weakening trend means companies in emerging markets should have more room for growth, and countries that did not prop up their economies with stimulus during the pandemic may be better positioned to return to a growth rate that's sustainable. Looking out over the next 2 years, respondents overwhelmingly made Southeast Asia their top pick, beating out Latin America and Eastern Europe by a wide margin.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
You can actually say that OPEC Plus has been fairly proactive and very, and had a very quick reaction in 2023 when the global demand numbers didn't pan out. In the short term, there is very little even OPEC Plus can do if there is a demand destruction in the market. Without this OPEC Plus action, I think we could be down to 60s in oil prices.
Let's talk about it a little bit more. Saudi Arabia, Russia announcing fresh cuts of their oil supplies on top of existing curbs made in an agreement with OPEC Plus, of course. Now the move pushing oil prices a little earlier higher, but now sort of steadying. Let's talk about it all with Bloomberg's Will Kennedy joining us. And it was anticipated by the market, right?
Some of this was anticipated. The Saudi extension, I think most people thought would happen. They'd said a month ago that they would cut their production by an extra 1 million barrels a day in July, and they've decided to extend that into August, but most people had priced that in. I think the Russia announcement that we saw today that they would extend their curbs, not to production, but to exports by 500,000 barrels a day, was more unexpected by the market. But the problem we have there is that Russian compliance with its existing obligations has not been all that it could be, especially in the eyes of those who count tankers and look at them. So I think when it comes to Russia's commitment, people will want to see it actually go into effect before they draw any conclusions about what it'll do to global supply and demand balances.
Well, Kennedy, we thank you for bringing us up to speed with the world of OPEC and OPEC Plus. Meanwhile, of course, oil feeding into manufacturing and the US PMI data just crossing as we look ahead to, of course, all-important ISM a little bit later. US payrolls, of course, come Friday. To break it all down, Bloomberg's Michael McKeon. When we're looking at the S&P global US manufacturing data, what do we see?
We're still seeing some contraction, but what's interesting is the numbers come out exactly the same as they were last month, 46.3, and that was what the analysts had expected. So it does show that there's still some contraction in U.S. manufacturing. Now, at the top of the hour, we get the ISM manufacturing report, much more important to the Fed and to U.S. economists, and in that we're expecting a slight gain, but still a contraction. The forecast for 47.1 after 46.9. line. Going to be, though, a busy week, Caroline. We have today the ISM numbers, of course, and tomorrow you can watch the fireworks. But Wednesday, we get the Fed meetings. And look at Thursday. Jobless claims, JOLTS, ADP, and ISM services. And then Friday, one major report that people kind of follow.
And remind us, I mean, how major it was last month. I mean, again, absolutely phenomenal strength and an almighty move on the bond market because of it.
Yeah, 14 months in a row, the number has come in higher than analysts' anticipation. So we'll see if that string gets broken. But even if we match at 225 right now, and that'll change a bit between now and next Friday, that would be still a very strong number. And the forecast for unemployment is that it goes back down again from 3.7 to 3.6. So labor market's still very strong unless we get a surprise. Fed's going to be watching that.
It certainly will be, as we will as well. Michael McKee, thank you for breaking it down. It's going to be a busy week amid those fireworks. Michael Purvis still back with us. Bring us some fireworks, Michael. What are you expecting in terms of what's the overall fundamental picture of the U.S. here? Is the Fed going to have to hike in July? Will it do so afterwards?
Look, in terms of economic strength, yeah, I think we're going to see more of the same for quite some time. I think there's a lot of structural factors underscoring this. What I think is happening is a stronger shift to a higher nominal GDP, inflation higher than it has been before COVID, but not a recession per se. Some growth to go along with that there, and that should keep interest rates higher. And I think I suspect that if the employment numbers on Friday morning are come in as advertised right now or stronger, yeah, I think that's probably going to mean a July hike. I think what's much more interesting and in some ways more relevant though is whether the cuts that have been priced in the market quite extensively right after the Silicon Valley Bank collapse, whether those keep getting eroded and you're starting to see really a much sort of flatter picture for Fed policy over the next 24 months. And I think that's where this is going right now, which probably ultimately means 10-year yields have to come up edge a bit higher there into a sort of a non-recessionary, but sort of a persistent strength and not quite collapsing inflation picture. Yeah, I think the Fed is not done yet.
But if we get, say, a 4% level on the 10-year, does that just bring in more buyers? Is there some sort of level out? Is there a top that we end up having because demand will just rush back in?
Look, I think 4% is a big, nice round number. You've seen buying there at that level historically over the, through this whole cycle. Could we get through that into 4.25 if the Fed deems it necessary to keep pushing not just up in July, but maybe, another one in September and perhaps even more later. But again, I think the question comes down to whether the Fed just sort of advertises what I call camping at a terminal, and they really work the x-axis and as opposed to tweaking rates up and down. If that's the case, then I think they're going to set the market's going to read it as policy rates are going to stay higher longer, and therefore you will get through 4% and maybe to 4.25. I would be surprised we get much higher than 4.25 at this cycle, but I think that's increasingly where this is going right now.
And I want to come back to you on your calls from sectors on the back of that move in bonds. Let's just, while we look at the equity market, S&P 500 currently flat, dig into some of the industries, some of the movers out there. Abigail, just break it down. What sectors are on the move today? How much is the oil market feeding into it, for example, those cuts?
Yeah, well, it is interesting, Caroline, because as you mentioned, the S&P 500 is basically just flat, but we do have some sectors on the move. Consumer discretionary, the best, up 1.5%. Not surprisingly, that has everything to do with the likes of Tesla moving it higher. As for energy, right behind it, but it's interesting, Caroline, just a small gain there, up about 0.2%. To the downside, healthcare and industrials, healthcare down by 1.1%. And then let's go back to Tesla and some of these other automakers, because we now have the S&P 500 auto index up. Take a look at that, up 16.2% over the last 5 days. Its longest winning streak since June, but not surprisingly, its best winning streak since early January, again, having everything to do with those Tesla numbers.
And very briefly, of course, going back to Michael Purvis, Abigail, you said you like banks, the yield curve, the inversion. Any other sectors you want to call out for us?
Well, look, I think there are selected materials here. I think, materials have been very soggy. The failure for China to really launch here the way certainly I expected earlier this year there. But I still think that there is ultimately a different supply story going across so many of the materials names here. And I think when you think about the relocalization of what's happening, you're seeing this explosion in factory builds in the Southeast right now, in the Southwest and other parts of the country. So that means that a lot of people that are making the inputs for that, whether it's steel, whether it's cement, and so forth, those names can be bought pretty cheaply there. And then away from that, I think, again, like Bank of America is trading at 8.5 times earnings. It's not a very exciting story there, but it's, the S&P 500 is 19.5 times earnings, and certainly skewed by NVIDIA and the other big tech names. But still, I think, buying a company that doesn't have an amazing earnings story, but has a decent earnings story here into a higher rate environment where net interest income is going to be pretty good, I think is probably a pretty decent play here. It's not going to make you super rich, but it'll be solid,
Michael Purvis, happy 4th of July. Go celebrate. Thank you. Coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
For the trading diary, what you need to be watching this week. Of course, U.S. stock markets, they're closing early, 1 p.m. Eastern today. Bond markets, that's 2 p.m. U.S. markets also close for the 4th of July holiday tomorrow. Then we get the fireworks of the Fed minutes on Wednesday. Secretary Yellen heading to Beijing come Thursday. And Friday, you know it, we'll round out this week with the all-important U.S. payrolls report. Just a phenomenal week to be getting your teeth into when it comes to fundamentals, but go have a really enjoyable, shortened day and exciting July 4th celebration. This was Countdown to the Open, and this is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Or other authorities.
Could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture down.
The OK is getting ready to make.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
This is Jess Minton and Madison Mills. We're filling in for Paul Sweeney, who's on vacation conveniently for the 4th of July holiday. But we're going to be with y'all for the next 4 hours, which is going to be a lot of fun. Coming up in the next hour, we will have Dana Patterson, the chief economist of the Conference Board. We're also going to have a commercial real estate roundup with Todd Henderson, who's the co-head of global real estate for DWS. And we'll have more coming up. But first, let's get a Bloomberg Business Flash with Charlie Pellet of Bloomberg News.
Very much, and here's what's going on. We've got stocks trading mix. Look at this first trading day of the second half ahead of a holiday tomorrow. Right now, we have got the Dow lower, down 42 points. That is a drop of just about 0.1%. The S&P eking out a gain right now has been fluctuating. It is up by a point. Right now, the S&P 44.51. The NASDAQ Composite Index higher by 43. That is a gain of 0.3%. NASDAQ 100 Index also advancing right now, up by just about 0.3%. 10-year yield 3.78% with the 2-year at 4.84%. Spot gold right now advancing $10 the ounce to $19.30 for gold. That is a gain of just about 0.6%. While West Texas Intermediate crude down 0.7%, $70.13 a barrel on WTI. So right now we are trading mixed as we kick off the third quarter. As for the market backdrop, Anna Hahn is equity strategist at Wells Fargo Securities.
With the acceleration in the market, I think what's important is what's really dragging up the market and how much more can that go. The technicals on the uber cap-led rally here look to be losing steam at overbought levels. But you've seen that really the correlation within these 500 names of the S&P 500 have declined because of that separation of these handful of names versus the rest of the market.
A lot of focus today on EV stocks, electric vehicles. Tesla, case in point, rallying 7.7%. Tesla, Rivian Automotive, and BYD all set sales records in the second quarter, likely widening their lead as the world's top electric car makers. Rivian up now by 13.4%, and Lucid, it is up now by 5.9%. Again, recapping, we're looking at a mixed Monday here. S&P higher by 1 point, little change. The Dow down 53, down 0.1%. NASDAQ higher by 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Jess Mitten, Madison Mills in the Bloomberg Interactive Brokers Studio. How fun is this over the next 4 hours?
This is the time
while everyone's away. And also, the stock market going to close at 1 p.m. Bond markets close at 2 p.m. And even though it seems like it's lighter on the economic calendar today, we just did get a flash about the U.S. manufacturing activity shrinking by the most in 3 years. So this is the Institute of Supply Management's manufacturing gauge, falling to about 46, the weakest since May of 2020. But Maddie, we do have that jobs report at the end of this week. So even though we'll have a holiday tomorrow, I know that other investors are looking ahead to that monthly jobs report.
Feels like a big jobs week. We've got ADP, JOLTS, jobs on non-farm payrolls Friday. It's a lot of job stuff this week.
We know Fed Chair Jerome Powell is going to be keeping a close eye on the jobs report. Obviously, too, for inflation gauges when it comes to average hourly earnings. But to get a bit of a look under the hood here, who better to bring in than Emily Grafeo, our reporter on the Cross Asset team. What are you watching?
Well, I'm watching the EV space, like Charlie was saying at the top of the hour, because these are some pretty big moves, particularly for a holiday shortened week. We have Tesla up over 7%. So they posted record sales in the second quarter, delivering 466,000 cars worldwide. They don't highlight in these quarterly reports exactly where in the world these deliveries are coming from, but that's a record number, beating estimates of 448,000. It was also up 83% from a year ago. So investors are cheering this news on Tesla. Bloomberg had interviewed one Baird analyst who said everyone was worried about inventory build, and it looks like that's normalized. And he also said the delta between production and deliveries is shrinking, which is what Tesla said they would do. And this is also following that push from the company to cut prices in order to pick up volume in the delivery space.
Yeah, it's really interesting to see that playing out and working in their favor. I'm curious about the moves with Rivian today as well, up even more than Tesla. What's going on there?
Right. When I first saw the Rivian news, I thought it was just Rivian moving up higher because technically, like when Tesla moves up, usually you see the other EV stocks. But Rivian also beat expectations when it came to their vehicle output, producing more vehicles and delivering more vehicles to customers than expected. They have 2 passenger vehicles, and then they have 1 commercial van, all electric, and Amazon uses that commercial van that Rivian produces. They also said that for the full year, they're on track to produce 50,000 electric vehicles. Last year, they didn't even produce 25,000. So that would be a doubling if they actually meet that goal. And we're seeing that stock up a ton right now, 14% up to the highest level since February. It has been kind of trading pretty low all year, just chugging along after plunging in January, but now we're spiking back up.
What about when it comes to some of these aviation stocks?
So we're very transportation focused this morning. I was also looking at Joby Aviation. I think I'm pronouncing that right. This is a $7 billion company, went public via a SPAC in 2020, and they make flying taxis. I'm not exactly sure how that's different than...
Please don't give me another transportation story. I can't do another weird, deathly vehicle.
They're calling it a flying taxi. It looks like a drone. I was looking at its website.
Please help me.
A flying drone. But this company also had its best week on record last week, soaring over 60%. Moving higher today also, and it's all because they had a go-ahead from the FAA that signaled the company may be on schedule to launch the first commercial air taxis in 2025. I'm getting a little silly here because it's July 3rd.
Oh my God, yeah, that's why are we all here if not to get a little silly on Monday?
We're the only ones left.
It's literally just us, so we might as well have fun.
And the flying taxis.
Yes. And also, I thought it's interesting that this Joby company, so it's backed by Uber, Toyota, Delta, Intel.
Yeah, and they also, so they have those partnerships. They're also, they have an agreement with the U.S. Department of Defense, and they expect to deliver their first aircraft to the Air Force in 2024.
Wow.
I had not heard of this company before this morning. And like I said, $7 billion in market cap, so it's not that large, and it hasn't been public for that long, but certainly seems to be making waves in the flying taxi space. I cover ARC and Kathy Wood a lot, and she's very bullish on a lot of technologies. She talks about flying taxis a lot, so my ears perked up when I heard this news.
Any sort of final thoughts before we hear from you again in an hour?
Well, speaking of ARC, I am looking at that ETF moving up. It's 2.3% higher today, outperforming that NASDAQ 100, which is what we see a lot. An ultra-levered bet on technology stocks. When the NASDAQ is higher, usually ARC tends to outperform, and we're certainly seeing that today. Some moves in crypto, too. That speculative technology, those animal spirits, as we're here the day before July 4th, seem to be taking the market for a ride right now.
All right, Emily Grafeo, cross-asset reporter at Bloomberg News. We're excited to hear from her again over the next top of the hour for the next 3 hours. Thank you so much. Up next, I want to get straight to our next guest, Dana Peterson, chief economist at the Conference Board, who's going to join us on Zoom. And Dana, I have to get your thoughts because we are just coming off of the data that we got last week when it came to consumer confidence and rising to the highest level since early 2022. How do you square that away when a lot of the data say GDP was revised higher for the second quarter, coming in stronger than expected, but then it seems like a lot of people, even if you exclude some of the sentiment gauges, still feel a bit gloomy, especially when it comes to what is ahead for the economy?
Sure. Looking at the consumer confidence measure that the Conference Board produces, yes, it did rise to the highest level we've seen in some time. But if you look at the series on a graph, it's been moving pretty much in the same range. And it's a range that's below the peak that we saw last year and also well below the pre-pandemic 2019 levels. When you look at the details, consumers are saying, well, things are okay right now. I'm working. I have income, business conditions seem to be okay. Looking to the future, they still expect that maybe there's something negative around the corner. Maybe there's a recession or a soft spot.
So talk to us then about this U.S. manufacturing activity. We just got this ISM data this morning. That's the Institute for Supply Management's manufacturing gauge. 8th month of contraction here, Dana. How happy is Jay Powell after seeing those numbers, or do you not necessarily look at that as a huge indicator of the macro picture here?
Well, factory activity is one important measure and certainly something that we look at and include in our leading index. And the reason why factory activity is so weak is because consumers are no longer buying goods en masse. That was certainly the conditions during the pandemic where they couldn't go out and enjoy services. Now they can enjoy services. So that's why we're seeing services, purchasing managers, indicators rising, and a lot of spending on services, which we saw in last week's PCE report.
I know you also have the Conference Board's leading index, which has been negative for 14 consecutive months. And it's something rare to see over the past half century. Typically, when you've seen instances like that, it's only happened in 1974, 1980, and 2008, where you've seen that sort of extreme time threshold there. But then the U.S. economy was actually already in a recession. What do you think this is telling us about the economy?
Sure. What the leading index tells us is that there's probably a recession starting right about now, which is the third quarter of the year. And certainly because it's been negative for so long, it does suggest that we will see a soft spot. We are actually forecasting a recession, but a short and shallow one. So